market structure, trend, and how to work with it. Let's dive in. Guys, on YouTube, there's million videos about a structure, market structure, and a lot of videos from the people who love to trade the ICT concept, the smart money concept. But guys, you can call the things on the chart whatever you want. You know, everything what we see on that videos is just terminology, what people use, because it's easiest to mark some things on the charts with terminology from the smart money concept. You can call that things whatever you want. You can call the, I don't know, the Marvel superheroes of things if you understand what are you doing right on the chart. Structure is, in the simple words, it's a trend. Also, you have to keep in mind, like usual, the trend is your friend, but time frame. Time frames, the time and the price, it's a 2K points would give us the information on the chart. So that's why we're trying to simplify the things on the chart. Don't need to build so complicated strategies. Don't need to draw a lot of complicated lines and marks. What does it mean? If you don't understand what's going on in general in the complex, and if you don't understand the context, what's going on now on the chart, no one strategy concept can't help you. We got two trends, uptrend. So we move just in uptrend. What does it mean the uptrend structure is? When we got impulse, this one, and this is a higher high than this previous high, and higher low. So this low, not lower than this one. Looks pretty simple. We made another impulse, higher high. So this high higher than this one, and a higher low higher than this one. And for example, it's a 12-hour time frame. On daily time frame, it will look totally different one. On the weekly time frame, it can be just a correction inside global range or inside global downtrend, just like example. And I will show you some few examples. Inside this impulse, you know, we will see the local structure, downtrend structure. About this one, we will talk in another video because it's about a multi-structure. Trend is your friend. If you work with 12-hour time frame, you have to work with that time frame, and your entry, your exit, your trades should be based in the complex, based on the context, what's going on now on the market in general, and especially on this time frame. So you're not mess your strategy. So this is a higher high, higher low, higher high, higher low, higher high, higher low, the same way, but in opposite way if it's a downtrend structure. So this is a lower high because we're not breaking out this one, lower low. And one day when we found the bottom at some level, it can be the favorable gap, it can be some liquidity pool. This is what I mean in context. So we have to work in a complex and in a context. Where are we now? Because if this was a liquidity pool on the weekly time frame, and on 12-hour time frame we drop it down, grab liquidity of weekly liquidity pool, we start build the reversal move, and we start build the new uptrend structure. So you have to understand it. It's not so easy, right? So in theory, everything looks so simple. Up, down, up, down, up, down. Trade, just open short. So open short, profit, open short, profit, open short, profit. But guys, in real life, everything not so simple because it's emotional, it's your real money. We got a stop losses, we have to count the size of position. But in general, you understand. So it's a trend. It's just an uptrend move. But every single time, pay attention for that time frame where you trade. So trend is your friend. Structure, I showed you. Pretty simple. Higher high, lower high. And downtrend, lower high, lower low. Pretty simple. Pay attention for the time frame, context, and the complex. And you can use the indicators to identify the structure. If you get some issue, or if you're just a beginner and you don't see the key points, you know, we will talk in the next videos about a break of structure and about all of this smart money concept things. But like I told you before, boss, like break of structure, it's just a terminology of ICT concept. But you can call that moment on a chart whatever you want, if you understand what are you doing. So let's take a look on Ohm. And also, guys, we got a flat. Also, we got a flat, of course. We got like uptrend, downtrend, and a flat. Flat is just a range. So I already made a video about range. So maybe I will post also some updates, some tips. So this is just a range. When we not form some crucial K levels, we not see that on the chart some high, lower high, or lower, high, low. So it's just a range. And guys, believe it or not, but you can open any chart and you identify, so I guess over than 75% time on the chart, the price move on sideways, in the flat, in some accumulation or distribution, or in reaccumulation and manipulation. So here's the Ohm chart on, let's say, daily time frame. So what we can see on this chart, technically, this was a flat. After that, we start build the trend. We start build the structure. So here, we got like impulse, correction, impulse, correction. How to count the impulse? It's also the subjective, because, for example, this is can be for someone, this can be the starting point of the impulse. For somebody, the starting point can be here. For somebody can be here. That's why, guys, there is no 100% correct answer how you have to identify the impulse, because if everybody identify the impulse correctly, everybody should be the millionaires, because we know the starting point of that one. And for example, we can use the starting point. So this impulse correction, we not form the lower low, right? We form the higher low, and we move higher. We got high, high, high. Impulse down, correction. Impulse up, new high, new all-time high till that moment, correction. Another impulse, new high, correction. And we're still in uptrend. So this is a still uptrend, but take a look. In the moment, it could be the, here, in a moment, it's gonna be like 35%. It can be like 43%. And yes, somebody say like, if we not drop like 50% down, we're still in a uptrend structure. But everything, guys, depends on the time frame. So for example, it can be the sideways move, right? On the weekly time frame, everything looks just like a beginning. Just like a beginning. So impulse, high, we hit the top. Drop, lower high, pump, another top, this one. Build a structure, top, drop, top, drop, top, drop. So you can identify. You can use the wicked fractals, the indicator, what I share with you, totally for free, to identify the key points. After that, we got an impulse, drop. Sideways, because it's a weekly time frame. Imagine 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 weeks in a row. It was just a flat. Just a flat. Another high, correction. And this is for Ohm, for mantra. We are in the uptrend since this first main impulse. And until we hold this trend, we work with a long position. So generally, we're looking forward, we're looking uptrend. And in next videos, we'll talk, of course, about a break of structure and all of that things. If we talk about, for example, Sol, weekly time frame, this time it was a downtrend. So we got like top, impulse down, weekly, bounce. This is lower high. Then we got like lower low and last point. In December 2022, at that current moment, we couldn't know it was the last point. We couldn't know. Now, of course, after the fact, we can identify, oh yes, it was a bottom. So easy, we should buy. At that moment, we can't know because maybe somebody thinks it was a bottom. And after that, we dump minus 50%. That's why, guys, I repeat, the structure looks pretty simple, right? Up, down, up, down, up, down. But in the moment, for example, now, how we can know we will drop lower or this is the end of correction? How we can know? Technically, this is an uptrend. What we should do now? We have to work in a complex. So by seasonality, by what's going on in the market now, and we have to wait some confirmation. Technically, we sweep at the high, so we break the downtrend structure because we start forming the downtrend structure since the November 21, and in January 25, we break off structure. So this is what people call it the break of structure. How to identify this is a real break of structure or not, because on 4 time frame we can see the confirmation. On daily time frame there is no confirmation. Confirmation, I mean somebody count. We have to close the candle, body candle higher than previous high. Somebody use the weeks. So take a look. Yes, we pump and close at the 12-hour time frame higher than previous all-time high. Technically, by all that rules, smart money concept, we can confirm, yes, we break of structure and now we have to open long. But what happened next? Next, we dump it like, let's take a look, we dump it 57%. If we dump it 57%, doesn't mean that it was a fake out or what? Or we're in a downtrend structure. That's why, guys, a structure is simple, but everything should be in complex. In theory, everything looks so simple, but that's why I use all of the things. I use the trends, I build the structure on a high time frame. Then, for example, I go to a lower time frame, and on a daily, I can see this is a downtrend structure, right? Top, low, some bounce, low, bounce, low. Bounce, looks like we should go higher, right? But we're going down again. Base it on the news. Theory, is pretty simple. You have to follow the structure, you have to follow the trend, but please work in a complex with all of the things. We go into 4 hour time frame and can identify the structure, a local one. Technically, this can be just a range. So it's not an uptrend structure, it's just a range. And inside this range, we can see the local 15-minute structure. Absolutely, just a tiny one local trades. Pump, drop, correction, higher, high, local one. And you can go to the indicators, type structure, and use indicators which just highlight you the high, high, lower, lower, high, for example. So you understand in the complex, in general, on the weekly time frame, we're in an uptrend or in a downtrend. On 12 time frame, we're in an uptrend or in a downtrend. And when we will learn the multi-structure, it's so complicated because we have to synchronize the time frames. If you have ever wondered how institutional traders move markets, why price seems to hunt the stop losses, or how to find the truly high probabilities entries, then this video is for you. Stick around because by the end you will understand exactly how to use the order flow in your own trading strategy. Order flow is basically the real-time movement of buy and the sell orders in the market. Unlike traditional technical analysis, which looks at the past price action, order flow focuses on what's happening right now, the liquidity, the aggressive buyers and the sellers, and where the next move is most likely headed. But guys, I repeat again, on YouTube you can find just millions top secret strategies, 99% win rate strategy, or some crazy idea which promise you the highest win rate in trading. Guys, everything what you see on YouTube, it's ideas, just the strategies for the back test and the tools to work with and adjust to your trading style and to your strategy. No one strategy, no one tool in the world give you the 100% guarantee so you will be profitable on a distance. So work with money management, with emotion. Why order flow matters. and why we should care about it. First of all, the order flows tells you who is control, buyers or sellers. It exposes hidden imbalance and the smart money activity, and it helps you catch precise entries, especially if you missed the first move at support or resistance. Instead of guessing, order flows give you the real-time confirmation. Here's some core principles of order flow. First one is liquidity. Price is attracted to areas with lots of pending buys or sell orders. This liquidity zones acts like magnets. Order types, its market orders consume liquidity and the push price, while limit orders prove support or resistance. Imbalance. Trends from when one side dominates. Aggressive buying in an uptrend, aggressive selling in a downtrend. Sweeps and manipulation. Price often hunts liquidity by triggering stop losses, then continues in the original direction. Let's talk about how the order flows works. First of all, we need to identify trend and imbalance. Check if buyers or sellers are clearly in control. Watch for liquidity sweeps. This stop hunts often fool the next leg of the move. Confirm with the context. Always combine order flow with the higher time frame levels like order blocks or breaker zones. Optimal entry zones. If you miss the initial entry, wait for the pullback. The best trades often come from discount in uptrends or premium in downtrends levels. Managing exits. Order flow weakens when imbalance disappears, volume dries up, or liquidity pools are reached. Now, where do we find the most important levels? First of all, we need to pay attention for the high volume areas, where the big orders clusters. Imbalance. Zones where aggressive orders tip the scale. Smart money zones like order blocks or breakers. Liquidity pools where stops and the take profit are stake at. And the point of control, POC. The single price level with the most traded volume. These are the battlegrounds where the institutionals step in. The best tools to use to identify the order flows, I can recommend you the footprint charts, show the buy sales volume at each price, depth of market, reveals the order book and liquidity walls, volume profiles, highlight the most traded zones, cumulative delta, CVD, the video about a CVD already posted, so this measure the buyers and with the seller aggression. And of course, guys, I recommend you combine all of these tools together when you work with a structure and order flow. Don't rely only on the candles. Order flow is about the real-time data. Don't ignore the high time frame context. Always trade in a sync with the bigger picture. Don't fight the flow. It's usually safer to trade with the active trend. So about the trends, I also post the video. So trend is your friend. Don't try to play against the market, especially on the high time frames. Imagine the price bounces from the support and you miss the entry. Instead of chasing, you just wait. Soon you will see aggressive buyers step in, liquidity gets swept and imbalance builds. That's your confirmation. You enter on the pullback in the discount zone with your stop safely beyond liquidity. That's how professionals use the order flow. Because this video will be for people who trade intraday or scalp intraday. This video is not for swing trader or for investor. That's why if you're investor, you can just skip this video. If you still interested, you can watch just in educational purpose. So guys, I use the reply bar, just showed you the example on Ethereum USDT trading pair in intraday. Why it's so important to analyze the session, because the sessions, it's not just random blocks. You have to understand like globally, we got main three blocks, main three sessions. So it's Asia session, it's London session, so Europe, and New York session. And you have to understand, for example, you trade, you live, let's say you live in United States around the New York, and you trade intraday. And let's be real, we are all humans and sometimes we sleep. Yes, sounds silly, but yes, traders sometimes sleep. And for example, you open trade and at the end of your day, of your trading day, of your work day, before you go to sleep or before you need to go, you close your trade. It's only your decision. You close your trade fully or add the stop loss at the break even, or I don't know, add a stop loss and go to sleep. So the newer session ended. Of course, crypto trade 24/7, right? But the Asia people waking up and see that, and they analyze the New Year session. What happened while they sleep, right? And they see the levels where liquidity levels were the United States traders mostly, right, at a stop losses. And the soft and the bots, of course, and the traders also delivered the price to sweep some of the liquidity pools. So that's a case. So the time and liquidity, it's a key. That's why I train myself to close my all opening position before I go to sleep. Because of course, it's by luck you can leave the trade for the next day, you know. But sometimes it's happened. So you're waking up and you get a stop loss, and better close the trade at the break even or close in the profit, and next morning you're waking up and start new working day. So it's more about psychological side of the sessions. Now about a technical side of the session. So first of all, you have to understand the context. You go to daily time frame, for example. So we are in the upside, right? We're in the upside move here. Example on Ethereum. Since the beginning of April, we're in the upside move. So we leave the gap on the daily time frame. So maybe in the future, this gap will be like a magnet for us to drop it back again. Maybe, we can't know. Globally, of course, we're in the uptrend. Global on the weekly, right? We go into the daily, and the daily we're also in the uptrend. So we move in the uptrend direction, right? We go into 12-hour time frame. What do we see here? Also the uptrend. Now it's like a range. 4-hour time frame, also like a range, right? And we moved, for example, to 15-minute time frame. Got it. In this case, I use the sessions indicator, trade on indicator, money power direction for intraday. So this is my tools for intraday trades. Here I turn on the session indicator. I use just this one, sessions. You can type in indicators and find there are a lot of indicator sessions. This one is good for me, for my time on the TradingView, for good visualization, right? So sessions, it's not a magic, right? Session is just a time. You can mark even with if you know the time zones, you can mark even the vertical lines. So here, for example, like boom. So this is a Asia session block. But the indicator just showed you kind of bad visualization of the time period, right? Like it blocks. All right, so I see the Asia session, we form the high, right? And form the low. I marked some data what you need to know also. Trading during the market sessions takes more than just guessing. You need a full strategy. Always trade what you see, not what you think might happen. Yes, it's a fact, guys, because the people try to randomly predict. I think we will go higher, maybe. Or I think we have to go down now, maybe. But we need to trade the facts. And the facts will be around the end of the session, how the session will close. So next moment, I want to show you this one. So we need to pay attention for the context and the trend. Done. So we understand we're moving forwards, uptrend. We need to choose the time frame. Time frame don't make sense to work with the sessions, on the 1-hour time frame or 4-hour time frame. We need more information. We need more information like 15-minute time frame and 2 and 5. 2 and 5, 2, 3, 5, 1 minute time frame. We can use that lower time frames to open the trades. But let's say like 4-hour time frame, it can be the favorable gaps. We can identify the favorable gaps. 1-hour time frame, the context, and 15-minute time frame, 5-minute time frame give us the range, right? The liquidity pools. You have to pay attention also to day news, reports, announcement. Highly recommend you work with economic calendar. It's totally for free. You can use the Economist or the Forex Factory. On Forex Factory, totally for free. How to work with, I already posted the video here. You choose the week or the day. You use the filter, right? This one, choose any of currencies, important, expected impact of the price movement for today, and you know exact time, basically your time zone, not time frame, time zone, when we will see volatility. So something will happen with the candles when we'll see the Charles job openings report. It can be the good or bad. And definitely you can be sure that time is exactly this second when they post that job openings, we'll see the volatility. Up or down, we can't know, because in the present moment, we can't know the data, right? So for example, unemployed claims also will affect. I use only the red one, which all the time impact the market a lot. So also you have to understand, today we got a news or not, because without a news it will be less stressed day, less volatile. So maybe news will not affect unpredictable the candles on the chart. Got it. Sometimes the news are good because some, of course, it's by luck. Maybe if you read the context correct about potential forecast of the unemployed rate, for example, you can catch that right, and we see the green candle, for example, with a good report. But it's just by luck, because maybe next time you'll be wrong with the guessing, right? That's why we need to mostly trade the facts of the news. So build the logic around liquid zone, not in the middle. So this is what I all the time practice. For example, we got the zones of Asia session. So here I can mark this like a top. This is going to be the target. And let's say this is a bottom of the Asia session, also like a target. So this is a magnet and this is a magnet. Let's mark like a magnet here. Bam. This one is a magnet, and this one also will be like a magnet. Bam. Two magnets. So this is liquidity. You can be sure the Asia people, right, traded here, right, traders traded here and open short position and leave the stop losses over than 2K650. So just a logic. It's not a random, or it's not a some random candles. No, about this candle, definitely around here, depends of the size of the leverages and the size of initial deposit. The people leave the stop losses, the real stop losses, and here stop losses. So people open short, drop here, close like 50% of the 15-minute time frame gap. So everything what we see on the chart is not random. Here, for example, bam. We can zoom in and double check. So around, yes, around 38. Around 0.5 level by FIB of 15-minute time frame favorable gap. We drop, hold the line, got orders to buy, mitigate position, bounce. In this case, when we trade in the middle of the session, I don't like to open position, any of them, because it's just by guessing, right? I can't know. We will go sweep this liquidity pool or this liquidity pool. By logic, I will be ready. I build my logic. I will be ready to open position or around here or around here. Got it. Next one is better weights end of the session. 100%. Liquid zones of the session and the structure. So technically, yes, we are still in the uptrend structure. So this is a higher high, higher lows, and even this one will be okay, and we can bounce if it's a range. But still, we earn the uptrend. All right, at this moment, I know we earn the local uptrend one. Next one is a break the high previous session, favorable gap or the block. It can be the entries for the trade. So you build the logic again. For example, this is a something around here, 5-minute order block. And while the price for example, climb it up to the top, you build a logic. I will be ready to see, and I wish to see some reaction at order block or sweep of the high and open the short position because of, and you build a logic why. And it will be logical entries because we got an end of one session and the price, for example, can sweep the high of the previous session. Got it. So we grab liquidity of the previous session. With the target can be the equilibrium of previous session or sweep of the low. Depends of your lever, depends of your size of initial deposits. You can work with the risk per trade. It can be the 1% or 0.5% risk per trade intraday. And like I told you before, I use money power, direction, and trading indicators like additional tool, which give me a lot of information. So take a look how it playing out recently. What can I see here on the Asia session? So here, trade on. Trade on, I use the last one. So we got some seller pressure. So that some guys ready to close position. They close position, bam. We drop, nothing happened now, no signal to buy or sell. It's on 15 minutes time frame. Let's go to the 5 minutes time frame. Here was a drop, sell. Here was a sell off. This is why it's important to use the higher time frame to identify the trend, the context, right? Even intraday, but open position, I use the 5 minutes time frame, 3 minutes time frame, because here this was a signal to sell around here. On 5 minutes time frame, the sell was here. Here we got RSI bearish divergency. So inside the Asia session, we already got a bearish signal because previously we trade in an uptrend, right? So logically, something around here, or here, it can be the logical exit. Of course, I couldn't trade Asia. I want to sleep. I trade mostly the London and New York. That's why waking up and I analyze what's happened during the Tokyo session and what can happen during the my session. So here, I explained the logic of what's happened during the Asia. So money outflow, MACD bearish divergency, sell confirmation. So here was a logical fixation of the profit, sell, crash, drop. Here's the accumulation back because it was the 15-minute time frame favorable gap. We bounce it, mitigate position, RSI bullish divergency, and we go higher. Here's a step by step. Somebody already fixed the profit. Step by step, just. So we move. Here's a London session, open it. So we can't know in a moment our London session will sweep this low before, first one, or this one. And I explained to you, in the middle, I'm better skip the trade. It's not enough for me the reasons to open trades now. And yes, maybe better skip the trade and then get a stop loss. Here, what I can see. I wish to see, of course, the sweep. But if it will not happen, it's okay. I can skip the trade. So I'm ready. I will be ready to open position. For example, here, exactly on the sweep with, let's say, 1% risk per trade. And we move on higher. Still here? No. And I'm still couldn't open position. Still not. Like you can see on direction, no signal to accumulation, nothing. New York session, bam. In New York session and London, they crossline it. Once again, close position, sell. All right. This is just an example. I will be ready to open short position at a logical short here at 1% stop loss. Maybe by end of the here, maybe by end of London. Bam. For example, my entries triggered. Trade on, like additional tool to sell. And I see the reasons. So we grab liquidity of Asia session in New York session, this magnet playing out. We got the money outflow, right? So it's preparation. So sell step by step. The guys who open it long here, they fix a profit. Step by step, they fix someone profit. Here's also be ready to close position. Here's a sell. And of course, I open position based on my risk. And this is a logical entry. We can get a stop losses. Absolutely will be okay. But in a moment, we have to take an action. And it was a logical 1.2%. The target where I can fix a profit. For example, if it's a range of the Asia session. So here, for example, I can close position now because we hit the equilibrium of the Asia session, 50%. I can close in this case the 50% of my position, add, for example, stop loss at a break even, and forget about this trade until we not sweep this this low or get a break even. And New York going down, come on, or break even, or take profit again. Bam, take profit. Sweep the Asia session. So this is a logic. And take a look how the price reacts. So we sweep the Asia session and the next candle respect that level. Finally here, we get a money inflow, a trade on no signals, no, only the buyback, right? And of course it's night, already sleep, and take profit, right? So this is a way how you can work with the sessions in general. So here is a Tokyo session. Maybe Tokyo will go to sweep the New York. London sweep. It's of course it's combined the London and New York. So sweep once again the Asia and the previous New York. So logic is once again that New York session. It was a previous day high. You can mark it. Previous day high. Previous day high. It was the high of the Asia session. This one. So it was logically here to bounce and grab the Asia stop losses and the previous high stop losses. So this is a way, guys, how you can work with the sessions. And it's really, really important to understand the K levels and everything about a time and the liquidity pools. Like conclusion, here's some checklist what you can use. You need to check the previous session first. So you're waking up and double check, depends of what session are you trade. You double check what's happened recently on previous session. Was it ranging or trending? So we can move in uptrend, like here, like it's uptrend in New York. Or it was just a consolidation here, range. And of course, depends of your time frames. Mark the session high and the low, mark it. So we mark it here, the high and the low of the session. Watch for liquidity traps. So liquidity trap can be this magnet or this magnet. So we mark the liquidity level. So realistic stop losses of real people. Next one is get context before you click buy. So you have to understand the context, global one from weekly time frame, daily one, trend, context, what's going on around, the news during the upcoming days. If the market bullish or bearish, right? The context really, really matter. Any clean zones where a retracement could bounce from. Maybe globally, this was the favorable gap on the weekly time frame. We can't know, but we have to double check, right? You combine in everything in the puzzle, right? Session overlapping. That's where moves often ignite. Wait and hunt. Don't chase. So that's a problem of many traders. The people want to trade so often. The people think the more trades, the more profit. And usually it's a false mindset. Be patient. Let the next session open. Yes, better, of course, wait or around or where the session cross-lined. You need to use that time. Better skip when the price traded middle of the session range. It's just my personal experience, of course, guys. Confirm your setup with a structure. When price pops or breaks, don't FOMO, wait for the pullback. So don't chase the train, if you skip it one, and protect your back. Stop goes behind the structure, aim for at least 1-to-1 or 1 to 1.5 risk ratio. Once you hit 1.1, move to the break even and let it ride. And of course, it's up to you. It depends on the leverage, depends on the initial size of deposit, right? So this is like a small tip, right? But guys, I recommend you also use the reply bar, right? Use this 4 indicators like money power, direction, trade on, a session indicator, and you will find the behaviors on your specific asset. It works all the time. So for intraday, this 4 tools, it's enough to understand the logic, and open the trades. You can open even 1 trade per day, right? With a proper money management and be profitable on the distance. I trade fair value gaps so often. I use it on different time frames. This can be the 5-minute time frame, the weekly gaps, daily gaps, even the 3-minute time frame gaps. Depends of what I trade today, or I scalp, or I open swing trades, look in some position for a spot. And for me, it's really helpful, but it's not a magic. Not all gaps should be close 100%. There's no gaps which showing you 100% correct entry and it will not hit your stop losses. No, guys, gaps, it's really useful instrument for me. How the gaps form? Basically, it's just 3 candles. You don't need to watch million videos about the gaps. It's pretty simple. Just 3 candles in a row on the different time frames. For example, 1, 2, 3. And this zone between the wick or the body candle close of first candle and the lowest point wick or the body candle or third candle format that zone. So this zone, it's a gap, fair value gap. That's it. But how to build the entries for that gaps, I will explain you in the next videos, because there's a lot of variation how we can use the fair value gaps. And this is a weekly time frame. I already explained to you how you can mark that gaps. Use the magnet, use the rectangle, add to the first point, to the second point, and mark the gap. You can go to settings here and create a template. You will save a lot of time with that templates. For example, I understand this is a weekly time frame, BLX chart, Bitcoin, historical chart. Here, weekly fair value gap. I mark it, so that's it. I save a lot of time. Monthly time frame, we can find out. So it was the gap. Here, first point, second one. So all that zone, it was a gap. And we close almost to the bottom. When we close to the first starter point, it's going to be the full fill of fair value gap. Pretty simple. This is a monthly gap, and I can go to templates and mark it monthly fair value gap. When you mark all gaps, it's pretty easy to work with your charts. We also got the gaps on CMA, Bitcoin daily time frame CMA. So gaps looks like this one. So just empty space. This trading day ended, and the next trading day open it, and we got that gap. Just empty space. In most cases, yes, we come back here. 1, 2, 3, 4. After 4 days, we come back and close that gap. The gaps, it's not a magic. It's not showing you the direction. It's just a zone where we can trade. There is no 100% rules for that gaps. You don't need to wait the always full fill of that gaps. So it's always individual. How do I work with the gaps? I use the FIB. For example, this is a monthly time frame. And let's use the reply bar to that one. All right, so we got a formation of the gap. So let's say this month already closed. I use the FIB, starting point, second point. I use the template for that gaps. So I use that one, fair value gap, and this one, fair value gap. Extend it, right? This one. And we can work with this. So the next month we go to weekly time frame, and we can work it, and we can work with. So this is a week. We test it again, that gap. Bounce it. In most cases, yes, we come back and close some part of that gap. Drop it down. Most popular entries for the gaps at 50% of gap. Here you can open long this one, or from the full fill. But guys, I remind you, it's not unnecessary. So the price should close 50% till penny, or full fill till penny. You know, that's why we have to work with the gaps like an additional factor for our entry. And of course, different time frame give us the different option, because this is a monthly favorable gap. On the weekly time frame, we got another gap, this one. And on the weekly, like you can see, we already tested 38 level by FIB. 0.5 level by FIB on the weekly of that gap will be 56,370. We bounced just at 38 level by FIB. So it's not a magic. Then, what happened next? So Bitcoin pump it. And come back again, slowly but surely, to that gaps. First one, here, we drop it down under 0.5 level by FIB of weekly gap, right? So we can delete it, weekly gap, and test 0.5 of monthly gap. The higher time frame, the more important zone. We bounce it from the 0.5 level by FIB of monthly gap. Technically, we can confirm, so we trade 50% of that gap and we can delete it. But we can drop and close even the full fill of that gap. That's why here under, we got a weekly gap again. And after a few weeks, take a look how the price respect the level of 0.5 level by FIB monthly gap. Bounce it. This is just a current moment. And here, take a look. After the few weeks again, we drop not to the full fill of monthly gap, but we close exactly 0.5 level by FIB of weekly gap, which we got inside this monthly gap. So you understand the logic. Inside a monthly gap, we got a lot of weekly gaps. Inside of weekly gaps, we got a lot of daily gaps. And we can move on to the lower time frames. So that's the logic of the price section. This is not a random. Let's go to the monthly time frame. Here, the next step, basically for correction, should be 37K600 or fulfill of monthly gap at 35,143 on BLX chart. Under, we also got a gap, this one, also monthly gap. Also, we have this gap. Yes, tested around 50%, but not a full fill. All right, but guys, you have to know, not all gaps should be closed, should be traded. Most likely, yes, most likely in the future, yes, for Bitcoin, we'll see something like this one, for example, and then in the next bear market, we come back and close that gap. But let's zoom in and try to find some gaps on a monthly time frame which will not close. So, for example, this one. Here, we'll leave it a gap which will not close even the 50%, I guess, right? So here. Yes, we tested only 0.38 level by FIB. This is a monthly gap which will not close 50% of that gap on the monthly time frame at 1K747 for Bitcoin. All right. This one is basically closed. This one not closed. Take a look. Here. We not even come back to test 38 level by FIB. Bitcoin monthly gap, $278, $272 per coin. This gap will not close to fulfill. This one, $16. So guys, just to be clear, not all gaps should be closed. Not all gaps should be traded, right? So work with the chart in a complex. How to trade, how to build the strategies, how to build the entries for that gaps. I will explain in the next videos where I will share some strategy, how we can combine some instruments to build the entries, for that gaps. But now you can identify by yourself every single gap on a chart and try to build your personal strategy for your entries. Accumulation, manipulation, distribution. Let's dive in. All right, guys, I want to show you just the two examples on link chart on the weekly time frame and the link chart intraday. So I already posted the video about initiation, accumulation, pump model, but it's kind of different because on that model, we got only one single daily candle close for initiation of the listing. This one big green candle. Accumulation, manipulation, distribution, it's a so popular model which we can track on the different time frames because this is how the big guys accumulate the tokens, and what they do next depends of the context, depends of the cycle, or depends of the session if it's an intraday trades. And guys, everything what we see on the chart, it's basically algorithm, and the patterns repeat itself on different time frames all the time, just all the time. It's just like a million combination what we can track, but we can find the steps, and try to predict based on that steps what the big guys will do next. So if you find something what you already seen before, for example, on 5 minute time frame, it can repeat itself on 1 hour time frame, on weekly time frame. And on the link, I want to show you the examples. Power of 3, accumulation, manipulation, distribution. We need to pay attention for the time frame. So if you work on some time frame, you always have to work with the higher time frame before. So first of all, we move from monthly, weekly, daily, 12 time frame, 4, 1 hour time frame, 15 minute time frame, 5 minute time frame, from high to the low one. First of all, we pay attention for the time frame. After that, we pay attention for the structure, how to work with the structure. I already posted the video. If you work intraday, you pay attention for the sessions and the structure. After that, you pay attention for the liquidity, how the whales, how the big guys hunt liquidity. And we try to open position mostly in manipulation zone. It can be the short or long. How it looks like. Take a look. This is a sessions indicator. You can type any of this indicator just totally for free. Type the sessions and find adjust to your time zone, and work with this. So take a look. This is a Asia session, and this is just a basic 15-minute time frame. It's just example, it's a accumulation range on 15-minute time frame. After that, we get a Frankfurt session, and in London, we go and hunt liquidity of the Asia session. So it means, the Asia traders finish to trade, go to sleep, for example, I don't know, and the London session hunt that liquidity at the opening session or in the middle of this session. We can hunt liquidity stop losses because in the context, it looks like this one. So here, for example, the guys open position here at stop losses. It's tiny stop losses because it's mostly high leverages, right? Because it's intraday on 15-minute time frame. And we just hunt that liquidity, hunt that stop losses, because what usually the retailers do. So we drop on a 5-minute time frame, on 2-minute time frame. They see, so we break some level, they open short, right, usually, but market makers just grab the liquidity and put the price higher. So this is how it works, and retailers who trade a classic TA, they wrecked and get a stop loss because here they trade in a long position, right, for example, but here at the breakout, right, so they start open short position, double stop loss. So here's a manipulation. So we get a accumulation, manipulation. So this is manipulation. And here we have to find the entry. Entry can be, depends of the timing, depends of the news, it can be one more sweep of liquidity, tiny one sweep. And in New York session, here's a New York session, we got like entry for potential 2.4% because we need to grab liquidity of manipulation stage. And distribution, it's a distribution step by step in New York session, or it can be different sessions, right? But this is how it looks like. So 1, 2, 3. That's why mostly we use all the time the 3 sessions. I'm not so often trade a Frankfurt session. And this is an intraday on 15-minute time frame. You can find a lot of cases like this one. So here, for example, accumulation, manipulation, distribution. It's not happening, every single time. Here, example, accumulation, it's everything intraday, 15-minute time frame. Accumulation, manipulation, because here we grab liquidity of Asia still in London session. Distribution, same story. Here's a accumulation Asia, manipulation in London, distribution. And take a look at the example on the weekly time frame. Guys, definitely we can't know the timing here. How long, for example, for the spot, the big guys will accumulate the assets. So here, it was an accumulation since May 2022. Basically, this is just a range where we build $10 for link and $4.81. So they needed time to accumulate as much as possible tokens for the spot position. After that, we got a manipulation stage. This one, let's mark it like orange. So we grab all of this liquidity, pump, and when retails, only here start buying, because the human nature never changed, the human psychology never changed. The big guys start distribute their bags. The logic for distribution can be like different factors. So in this case, it was like a weekly time frame gap. Here, this one, this high, we close almost fulfill of the weekly gap. So it was a logical exit right after a long time period accumulation, May 2022, and over the 1.5 year, somebody accumulated a link, after that we got a manipulation, and there was a step-by-step start distribute the tokens. Retails hop in here, and after that, what do we get? We got a distribution. And you can say, oh, it's not a big deal. Guys, it's a big deal. Whales distribute and take a profit like 180%, even from this top to this bottom. And they fix a profit at around 373%. And the guys who hop in here, they need to, at the break even, wait to almost 200%. Yes, of course, we bounce it. We bounce it higher. It was a logical, right? But a lot of people cut their losses, out of position. And if they trade even with a second leverage, they get a liquidation, right? Or at the margin. On the monthly time frame, it looks absolutely the same story. So here, accumulation, manipulation, pump model. So accumulation, manipulation because we grab liquidity, distribution. So here's the distribution, here's the distribution. And retails did the same mistake all the time. They hop in only here. You have to accumulate together with the whales here. But retails take an action always impulsive, too emotionally. So they wait some breaker, they wait some confirmations, but this doesn't work like this one. So guys, highly recommend you just use reply bar, to find some patterns on your favorite trading pair, to find this model. Accumulation, manipulation, distribution. If you work intraday, I highly recommend you use some of the sessions indicator. On YouTube, millions videos about a premium discount, how to trade it, how to work with it, but just basic information what we can find on YouTube or on Google, or in a box, in a basic rules of trading, I want to share just my experience, because on this channel, I share my experience on different questions, and in theory, everything looks so simple, right? Buy low, sell high. So not vice versa. But on the distance, when you start trade, real account, real money, there's a lot of moments where you have to pay attention and understand more the logic and the, like context. Not just buy, sell, and you become rich. No, it doesn't work like this one. Even if you understand the theory, what I can tell you about the premium discount, you have to pay attention more, not about the zone. You have to pay attention more about the time and the time frame. Because, for example, if we trade in the bear market, globally, we are in a downtrend. So it's a structure. So you have to work in the complex structure plus premium discount zones. Next one, we have to work with the time frames because it's so simple. Again, buy low, sell high. But if you trade on the 5-minute time frame, and you bought in, like in discount zone, it can be still the sell zone on a weekly time frame. So that's a problem, guys. So that's why we have to always work in a complex. So next one, it's what we can use. We can use the FIB and the volume profile to understand where the main zones, comfortable zones, depends of the time frame. For this one, we can use the VPVR indicator, or for example, on CoinGlass like heat zone or liquidity heat map. In basics, what the premium discount mean? For example, we work on some time frame. Let's say it's a 4-hour time frame, and we got an uptrend. So we got an impulse, some structure. About a structure, I also will share the video. So we get a structure uptrend. So this is how it looks like. So impulse, and we find the top. But in the moment, we have to understand it's not like constanta. So maybe we trade in the tiny range and going higher. It means we have to adjust another FIB, another FIB, another FIB. That's why it's first difficult what you found when you work with a premium discount. That's why we have to pay attention for the volume. We can use the basic indicator volume. And when we see, for example, like on this example, here we go in higher. This is a volume increase. We found the top and we find the volume decrease. So the price go higher, but the volume decrease. It means not so much power now in a boost to push the price higher. Also, you have to pay attention, for example, by timing. So if it's a weekly time frame, we get a seasonality. It's a March. It's Sol, a USDT example. It's a March before the summer. Usually, the big players, the institutional, start fix some their profits, because they go to vacation. And during the summer, the volatility on the market, not so big one. We can use the weeks indicator for volatility. Got it. So anyway, let's say we got this impulse. Impulse correction, impulse correction, impulse correction, impulse correction, impulse. Got it. So we find the top. So the volume decrease. We use the FIB to work with the premium discount zone. I highly recommend you and create the templates, so it saves you a lot of times. How to create it, how to work with the templates, I already posted the video. So for example, you create a template for the FIB, just a basic FIB. I use the fair value gap, another one with another numbers. The main FIB 27 zone, what I use also, and the premium discount FIB. So I use premium discount. So we use a magnet and you identify. So this is a bottom, this is a top at this current moment. What do we get? We got the premium discount zone, red one. It's a premium. It's a time where we need to fix the profit. Don't try to catch exact top. Don't try catch, higher price. So everything absolutely individual. When you trade with second leverage, maybe this impulse is not enough. When you trade with a 50x leverage, this top will be crazy profit. So guys, there is no 100% correct rules when to in, when to out. If we got that rules, in theory, everybody could be the millionaires. So we identify, we are trading in uptrend, daily time frame, on the weekly, on the 4-hour time frame, on 1-hour time frame. We work in an uptrend. That's why while we trade uptrend structure, we will use discount zone for longs. Got it. If we trade in the downtrend, we will use premium zones for short, to open position short. So we have to work in a complex. Got it. So we got an impulse. It means in this area, when the price drop under equilibrium, so middle line, it's 0.5 level by FIB, it's called equilibrium. So when we drop under middle line, it means all this block is comfortable price to buy on the spot or with the leverages for continuation of the trend. Invalidation of this idea, because in the current moment, we got only the idea. This was the bottom, this was the top. We can see this one. It will be the invalidation of this premium discount zone. It means we identified the premium discount zone's impulse wrong. It's okay, because in the current moment, we can't know, right? So we work with the possibilities. So this is a discount zone, this is a premium. We also, when we just start impulse, we can't know is it a discount zone or not, because on this impulse, we got this zone. So this is an impulse and this is a correction. Correction not hit, for example, the equilibrium, or maybe, for example, like this one, hit the equilibrium. Equilibrium, usually it's also the comfortable zone to buy, but with not so good, risk reward. So how we can trade? For example, we can trade with the leverages and work with the proper risk management. So this one, you can add your limit order at equilibrium at the beginning of discount zone and adjust your stop loss. So for example, it can be the big stop loss, like 10%, with the second leverage is 20. With the, continuation, 71%, so it's 140% profit if we use second leverage. And let's imagine the price drop like this one, touch equilibrium, retest, and going higher. You're in profit. So it was a right decision. But much better work with less risk in deeper discount zone. So it's with another FIB, can be like this one. You remember the basic video about a FIB in discount zone. So here's a 0.5 starting of a discount zone. It's much better to start accumulate token on the spot or with the leverages, at these blocks at 78 and 86. Of course, on this example, it's a huge stop loss, right? So just example. So take a look in discount zone, you can save like 50%. So that's why, guys, even the discount zone can be different. This is a comfortable price to buy at discount zone, and this is a comfortable price. But difference between the equilibrium and 86 level by FIB is 50%. That's why, guys, there is no magic where exactly you should buy. Absolutely everything individual. Where is comfortable price for you? But you have to understand we got an impulse and discount. When we got an impulse, the markets move by structure, up, down, up, down, up, down. No makes sense to buy the token in the premium zone. Yes, of course, we can see the movement like this one, like we saw, for example, on Nero, not touch the equilibrium and going higher. Of course, we can see this one, but base it on risk management, money management, better open position or better accumulate only in discount zone. For me personally, much more better to skip the token. And I explained it you on intuition accumulation pump model, why I sometimes skip at the tokens, even if we start going to correction. Because for me, that correction, it's not enough to take an action and buy the token. That's why I pay attention for the time, premium discount, FIB, and the volume. Take a look, example on Sol. Let's hide. So the basic, you understand, right? Take a look. This is a weekly time frame. We can use the premium discount zone, global one. Let's use the magnet. We got an impulse. So this is this one, lowest point to the top. Let's say in this moment. No, let's say in this moment here, because now we saw in the history, but in November 2021, we couldn't know is it the top or not. It's now easy to use the historical chart and say, oh, it's a top. Guys, in the moment, we couldn't know it's a top or not, or we can go in higher. That's why, let's say we use the impulse, correction impulse zones. So we use the Joule, last low point. Here was the top. And we work with that zone. Extend lines, right? And here, for example, we identified if the price could go higher in December 2021, we should adjust the FIB. Take a look what we can do next. We understand technically by cycles, it can be the end of cycle. Got it. So it gives us the information so we can identify the range correct because of cycle, because of news around. And you remember the hype about the SOL in November 21. We checked the correlation between the SOL and BTC. So everything on the chart signaling us it was a top. So we identify it's like a top. Next step for the downtrend, we identify it will be comfortable zone, start accumulate SOL back at test of equilibrium 145 and at the lowest point of the equilibrium $21.82. In November 21, we couldn't even imagine. So we will drop to under this zone to $9, for example, to $10. Nobody could even imagine, right? That's why we have to work in a complex, go to monthly time frame, take a look how low we can draw because we got a liquidity pool here, we got imbalances here on the monthly time frame. But I repeat, in November 21, nobody even think about the SOL can drop so low, right? So what we can see next? We're going down. So it's premium zone, it's not comfortable zone, it's no makes sense to buy in this area SOL again. So the same story with XRP. While the XRP trade now at $3, for me personally, it's no makes sense to buy XRP for potential 50% gains if I see many tokens, other tokens in discount zone the same time. So what do we can see next? We're going higher. You can see how markets react. So they give the hope people, so we're going higher. So we're going down. By the way, it's a weekly time frame. Now you will see how the price will react and respect the equilibrium. Take a look. Bam. And here, take a look how the price reacts in the moment exactly at equilibrium. When we see that reaction, it means we identify the levels correct. I guess, yes, take a look. So it means, yes, we can continue work with this range because we identify and see how the price respect the level. We grab liquidity, test equilibrium. Got it. It means I will not buy at equilibrium because I understand it's a January 2022. I check the news and I understand the logic. So most likely we will go down in the bear market, in a downtrend, and we'll close and trade all this order flow. So sooner or later we come back and test the order flow. What we can see next? Here, I understand in this area, it can be the comfortable zone to buy. So here, we dropped to 81. Technically, in January 2022, and logically, based on the rules, it was a comfortable and logical price to buy, you know, because if we use the like main FIB, so just in average here, it was a logical time to buy because we passed the 0.5, passed the 61. So I could wait 74 and 58. And base it on the rules, right? Take a look how the price react at that levels. We try and going higher, going down, down, almost touch 78. Of course, now we track like in a history, so it's easy. Take a look, reject at 0.5. Now like rejection, you know, the sellers, because of cycles. Here, we got a like support 78, this one. So we got a reaction, hold the line, but after that, we drop it lower. And in this area, based on all rules, you know, we should accumulate the SOL. And for example, we bought at 56 and wait the continuation to the next high. But Take a look how the market reacts everybody around. So 56, you remember the number. We bought at 56. But we leave the liquidity here. Inside discount zone, all the zone, it's comfortable price to buy, but we leave liquidity. 1, 2, 3. And we just hunt that liquidity. That's why, in theory, everything looks so easy, right? But we have to work in the complex with all data. And you remember what happened next. After that, we saw the FTX and the crash. So the news also affect the market. So we build the liquidity and dump. Dump, grab all of that liquidity and dump to $12.38. After that, we're going even lower. It was $10.94. Even lower, $7.96. So we dump it on the discount zone. In this case, we understand basically this zone invalidated. Invalidated, even if we use like this one, because we can't know which one is the starting point. So we delete it. Go back to monthly time frame and understand. So we drop, close the gap. If we use the monthly time frame, that's a problem of the time frames here. Premium discount. In this case, we're still in discount, and it was a logical also entry. For example, we bought at 56, we buying it at 8. So the average entry could be, I don't know, like 33. Based on seasonality, based on the cycles, we understand we are in discount zone. And this information gives us the potential vision of the recover move at least to the equilibrium. So we trade in that zone. And yes, it's happened. So during zone 23 to zone 24, we trade, accumulation zone in discount. And after that, the market makers put the price of SOL much higher. We reject and test equilibrium, pass at the equilibrium, retest like support. On the monthly time frame, we tested several times equilibrium, going to again premium zone where we need to sell. And they can work with seasonality and timing. Once again, the March zone 24. And the SOL dump it here 46%. Because we trade in discount zone. When we pass the top, it means this invalidated, and we can use totally another model, to identify by fee, but the next potential levels. But the logic of premium discount zone on the month time frame, on the week time frame, was correct, and it was not a mistake to start accumulate a SOL at 56 and, for example, at 8. To build the average entry like 40 or 30. Got it. So this is a global one. Also, you can pay attention for the volume on the monthly time frame, on the weekly. So here, this was a massive sales. Then we trade in range with not so big sales, and here's a volume increase. In this case, based on seasonality, based on the logic, based on the news, you could accumulate the SOL again. So this is what about the SOL. Again, you have to work in a complex. So if we work in the uptrend, here, in the uptrend on the weekly, maybe we'll not see the drop so deep inside the discount zone, because take a look. This is, for example, impulse. This is a top. So this was an impulse. This is a top. And look, you can see we did not touch even the equilibrium. That's why sometimes it's happened. And to buy here or not, it's only up to you. And if, for example, some new users who trade by FIB, they wait the correction deeper because we got an impulse and we wait the correction at least to 0.5 level by FIB. But it won't happen because in global, on the monthly time frame, we are still in discount zone. So here we are in the premium, on a weekly, but on the monthly, we traded in discount. The same story, for example, we trade now in a premium zone, time to sell. But of course, on 4-hour time frame, here, we trade in discounts. So this is a impulse. It's a 4-hour time frame. So this one. Global one, monthly, weekly, we trade in the premium zone. It's time to fix the SOL, right? But on the 4-hour time frame, Here, it was not a mistake to buy the sol at 176 or 184 with a potential target like equilibrium 232. And only the time will show us if we going down and invalidate this premium discount zone 4 time frame, or this zone is valid and we going higher to the next target. That's why, guys, premium discount, it sounds so simple, right? So we got like impulse and you wait the correction and buy, accumulate here. But imagine how it is going to smell if we use that premium discount zone for time frame, and you bought it 226, you bought it 189, but then we drop to equilibrium again to $84. And yes, it's possible. So guys, work in a complex with the premium discount zones. Also, a few words about the initiation accumulation pump model. So take a look. You remember how to work with this model, and I identified the levels where the zone of interest after leasing. Yes, we more than enough for us. Use just one single daily candle close. So this one. And here we use the leasing price, we use the body candle close, and we identify the premium discount zones. So 0.5 is going to be the equilibrium of this zone. For me, everything what is over, for example, on outlier, equilibrium is 16 cents 44. Everything what is between 16.44 and 32.27, for me, it's a premium zone. For me, it's not comfortable to buy the asset at this area. And I explained it to you with Celestia token. Celestia made a move like this one. Celestia dumped to 23 and going higher to $20. And only after the few months, the Celestia came to the zone of interest. So the time, we can't know the time. In theory, everything looks so simple. When we trade in real account, in the moment, you can't know the time when this token will drop to zone of interest. We can know where the zone, but we can't know that when. And this is why the premium discount zone, it's so complicated. And only your decision, determine the losses or the profit of your trade. So that's the point. I made a deal with myself. If I use initiation accumulation pump model, and if some token not drop to my zone of interest, I skip this token. And take a look also why even the initiation accumulation pump model can be complicated. Because we got a rule, and the rule is the drop on the listing price is invalidation of idea. Got it. Also, this is the okay zone to buy. This is the bad zone to buy where I can start accumulate the token. Got it. And at the end, like you can see, what happened next. So outlier pump going over then even the premium zone, drop it back, not test 23, going higher, form the new all-time high. And after, imagine the token listed on a Binance in January 2024, and only in February 2025, we landed here in August 2024. After the half year, we landed to the best zone to buy. Bounced, rejected 38, and come back again to this zone. That's why only now, only here and here, I can make a decision to invest in this asset because we are trading in discount zone, which is comfortable for me to invest in this asset. But I keep in mind scenario so we can invalidate this idea. Got it. Also, when you use initiation accumulation pump model and trying to identify the premium discount zone, I highly recommend you use the few sources, like few exchanges, because all exchanges list the token with the different prices, and take a look. If you could use the Bybit for outlier, everything could be the same, right? So the same model, the same rules. So here, looks like okay, right? So this is a premium, I need to sell. We drop it. Here, I bought, I'm buying, dump. And if you use the Bybit for premium discount zone, you could be in losses like 86% from the entry at the lowest point of discount zone. That's why, guys, it's so complicated to use even this simple model like, oh, buy low, sell high. So on a Bybit, you could be in losses 86% from the entry. On the Binance 30.29 cents, it was only here. It was only around zero level. So that's the point, guys. That's why work in the complex with all data and build a strategy based on your risk management, based on the news, based on the seasonality, on the time frame, and work with comfortable time frames. If you, for example, trade on 15-minute time frame, like an intraday trader, right? So work in this case not with seasonality, but work in this case with sessions. So for example, this is a 4 in the morning, you sleep. So this is Asia session, right? So here, let's say Asia, from the low of Asia, we formed to, this was whole day, till New York session. At the test of equilibrium, you can start use, for example, like here, it was also night. So here, morning, London. At this area, you can try open position like 2% stop loss with a target. It was a logical entry because we got an impulse, we trade in range. This is morning, you waking up, we got a low of Asia, so we got a stop loss here. So it was a logical entry in discount zone on 15-minute time frame in London session with the targets higher. Of course, you could wait this target, but don't be so greedy and fix profit step by step. Because if you not fix the profit, you got a stop loss in London session again. So that's the point, guys. So if you trade intraday, you open position with a leverage, you close position. That's it. So you don't wait and don't try to catch exact bottom and wait. So yes, finally I found the bottom and we skyrocket to the new all-time high. No, here you catch the bottom, get a 10% trade with the second leverage, it's a 20% profit, you could fix the profit. Because if you want to fix the profit, you got a stop loss with 2%, 4% with the second leverage. And the same way, you can work from equilibrium with risk management. Optimal trade entry, it's a pretty simple model, for this model, we use the FIB, just the FIB, but FIB we have to use in the complex with other instrument and in a context. This is a current example on the BTC, right? So when we hit the 74K, it's on OKEX, on the perps. First of all, you have to work on that chart where you're trying to trade, because if you analyze, for example, on the max a chart on a trading view, but open position on a Binance, it can be totally different entries because of liquidity, because of wicks, because of volume. First of all, what do you have to pay attention? You have to pay attention for liquidity hunt. So all the time, the market makers, believe it or not, but everything what you see on the chart, it's just algorithm by market makers, by centralized exchanges, and the big guys, who can control the market. And this is a liquidity hunt. So you have to work with optimal trade entry when we form some reaches some K level on high time frame, or sweep the K liquidity pool, for example, and we can, for entry, sweep liquidity. This is a 1 hour time frame, or form the equal lows. In last cases for BTC, we formed the equal lows on 1 hour time frame, but 74K, it was the fulfill. Almost the fulfill of weekly gap. So everything should be in the complex, and you move from higher time frame to the smaller one. And entry, of course, should be on the smaller time frame, because when you move from weekly to the daily to 12 time frame, 4 hour time frame, 1 hour time frame, 15 minutes time frame, 5 minutes time frame, you reduce your stop loss. So stop loss become a smaller one, and it's give you the better entry for the trades. We talk about futures, how to count, the proper risk. I already posted the video. So it's only up to you which leverage to use. Next one is a K level. We talk about it. So on a higher time frame, it was the fulfill or the 50% of the weekly gap. So everything logical. Now we can start looking at the entries. But how to know, are we going lower like this one or not? We have to work with a structure. With a structure, with in this case, lower high, lower low, lower high, and higher low. So this is a structure. I highly recommend you go and check the video about a structure. And we have to work with the both breakout structure. We have to work with the swings and the time frames. For example, if you want to open trade on 1 hour time frame, you focus on 1 hour time frame in the context of higher time frames. So for example, you determine, we come back to weekly time frame gap, logical entry, good one. We need to find the entries on 1 hour time frame. So we form the echo lows and we wait the breakout structure, fair value gap, and find the optimal trade entry. Got it. Plus you can add the sessions. So what we can see here, we form the echo lows and take a look. We can use the 2 fips. Of course, in the moment, we can't know right here what will happen next. Are we go like this one? Of course, after the fact, it's so easy, but I showed you just example, and you can just take a pose, screenshot this model, and use it, try to find on different time frames. It's repeat itself all the time on 5-minute time frame, on 1 minute time frame, 2-minute time frames, 15-minute time frames. Just an example. So in a moment, guys, take a look. To identify the swings, I can recommend you to use the wicked fractals. So it showed you the last swing. If you can't identify yet by yourself. So here was a last swing, 3 candles, right? Drop. This is a bottom swing, pump. Let's go back to 1 hour time frame. Yes, this can be the major breakout structure on 1 hour time frame. Breakout structure. We need to break this high, for reversal move on 1 hour time frame, and especially on 4 hour time frame. We got this last impulse down, last low structure, impulse, right? We can draw, for example, the FIP local one. Here we got a impulse. This is a swing. This is a correction to optimal trade entry. Why it's optimal trade entry? Because on 1 hour time frame, we form the gap. This is a gap, and entry on our here should be by FIP 0.621 lower by FIP, and minus 0.79 or 78 and 6, 8 and 6. So it's not some one level; it's a zone between these two. So it could be the logical entry. Let's mark like blue one. So this is a fair value gap. This is a logical zone. So it's optimal trade entry, OTE. Let's mark it OTE 1 hour. And stop. You should add, you can buy with 2 orders, here and here. So in average, the entry is here. Stop under these swings. It's like 1.3% or even under the echo lows. Around 2% stop loss with potential targets, right, to the break of structure on 4 hours time frame, right, and the main K level. It's like 6% profit. Take a look what's happening next. Bam. All right, we confirm it. If you watched previous videos about FIP, when the FIP form the correction to 0.5 level by FIP, basically these FIP are done. If we form the 61 or even these levels, also done. What do we have to do? For example, these FIP are done. We have to draw another FIP from the new impulse. So we can delete it, and we can draw another FIP from this entry. So this one, and take a look where the price stop in a moment. So we break the structure and we use another FIP, this one. This is another impulse top. What are we waiting for? We waiting for correction to 0.5 level by FIP. It can be a more risky entry, but it's okay. It's a okay, normal, healthy entry at 0.5 level by Fib. But the optimal trade entry, it could be here in this block. Plus, we can identify, we form the gap on 1 hour time frame here. So this is a favorable gap 1 hour time frame. This is a OTA 1 hour time frame. What's happened next? We can mark the entry here, but stop loss will be a kind of big one, 5%. Or we can wait around here. The stop loss will be like 3%. So we reduce the stop loss, guys, and wait the target. So what's happening next? We can't know in a moment, are we drop to the OTA or not. We stop it at 61. Take a look the price, how the price react the level. So it's not random, guys. Technically, we formed almost the full fill of 1 hour time frame gap are done. And you could open position here. At least your first limit order triggered. What next? And like you can see, we never back to 79 level by Fib. So technically, from your first limit order, this one is not playing out, or even this one playing out. So here, because with a bigger risk, you could fix a profit like at 27 block, like 8%. So yes, the risk was 5, but the profit was 8. So it was a entry after the break of structure, logical one, with a context, because we formed also, for example, double bottom on the 1 hour time frame. We closed the full fill of 1 hour time frame gap. We formed the test of 0.5 level by Fib for normal entry. We hit the 61 level by Fib for the first entry from OTA. And if you open from first level, the risk could be 4%. So you reduce the risk, and the profit is 9.3. So the differences between the entries is just the size of your risk, and the profit. And not all the time, guys, the market maker will drop the price after the impulse exactly to this level. No, not all the time. 0.5 is enough. First limit order, second one, third one. Average entry could be here. Target usually is 27 block, like first trouble area, or in the complex, you should wait this high. And what's happening next? So with correction or without correction, we go, it's 1 hour time frame. Let's take a look. So what happened next? So this is the target. How many time we spend around this levels? Bam, reach it, done. So you could fix some position here and fix even higher, 16%. For example, when you fix some profits, I recommend you just add your stop loss to the break even and forget about this trades. So guys, this is example of optimal trade entry. I'll recommend you go and check the education video about how to work with the Fib, just basic one, how to work with the 27 level, how to work with the structure and the break of structure, how to work with the range, flat, sideways consolidation. You can call wherever you want. Let's dive in. So guys, all of this terminology, it's absolutely the same things. It's just sideways. So technically, we know the chart, the price, always move to the right side, right? Believe it or not, but 70% of the time on the market, we trade just in a flat. And guys, it can be the kind of a long video, but I'll try to explain you everything in details, so we'll not come back to the range term in the next videos. I'm making notes here. So the range, flat, sideways consolidation, it's absolutely the same things. Different things, it's compression, because compression can be like a downtrend compression and the uptrend compression. So it's not a compression, it's not always the flat. Next moment, you have to pay attention for the time frames. Yes, Everything what we see on the charts, it's just basic fractals, basic patterns. And what happens on a weekly time frame? Absolutely, almost. It can repeat itself on a 1 hour time frame, for example. That's why you have to work with that time frames and work with that range. What do you trade? Because, for example, on a weekly time frame, it can be the downtrend, but on 4 hour time frame, it can be the range. And you can work with that range and get a stop losses or liquidation because you think on this time frame we should go higher, for example. But on a weekly time frame, we are going straight to the bottom, right? Again, next one, like I told you, price moves sideways 70% of the time, while only 30% of the time it follows a strong trend. It can be the downtrend or uptrend, and we can work with the range for swing trades. And yes, many people hate the ranges because everybody want to see only the up only trend or down only trend, so you can open short. But technically, guys, the range is a really good time period on the market because we can open the more positions. You have to understand it. We trade in some flat, and we know the range, where the top, where the bottom, and where the equilibrium, for example. And we can open as much as possible trades, for speculation to generate the profit. It's pretty good one because a trend can shift in a moment. You have to understand about the time frames. I already explained it to you. This is example on the link. Why we trade long time period, for example, on the weekly time frame, on the link and the sideways, because the whales, if we talk about a spot position, depends of seasonality, depends of market cycle. The whales use, based on my experience, I can confirm it. The whales use the weekly time frame, sometimes even a monthly, for accumulation. So yes, it's a long, boring chop consolidation period. Really boring, right? And exactly this time, the whales accumulate their spot back. Next time, we can use the money power indicator when we see the money outflow, when which can track, for example, on the weekly time frame, the take profit indicator to identify when the whales step by step distribute their bags. So it's really useful time periods accumulate together with the whales, because I explained to you they can't basically at the bottom press buy market with a billions USD dollar position, because it will be the crazy spike like this one. And of course, they will not accumulate as much as possible link, because the entry will be not in average. The entry, if they press buy, the order will be filled not at $7, for example, for link. There's going to be this huge spike, and average entry could be like 20. That's why they buy sell on a weekly time frame, on a daily time frame, to accumulate as much as possible coins. So that's the point of the range. Of course, we can see this 2 weeks. Sometimes the market makers, the big players, can press sell by market and the sell large position. But of course, I understand they will adjust that decision to some news, to some market period, for example, to some far around seasonality. It can be the, for example, sell and may go away, even like it happened here in 2021. So of course it was a trend. So they sell it here, sell it here, drop. Last position by market, yes, they can dump in 2 weeks. But when they need accumulate position, right, they accumulate longer. Take a look about the time periods. This, for example, we got a trend. This is a, let's say, uptrend move from the last correction. This one, 77 days, right? Next move, we got from this drop to the last point before reversal move, 70 days. From this point to the, let's say, to the top here, 112 days. From this top to this bottom, we got 105 days. So you understand the trend. Uptrend, drop. Uptrend, drop. Uptrend, drop. And the same way it's a downtrend. But the 70% of the time, we spend in consolidation, 525 days. You know, the trends, it can be local one, drop, local one, drop. After that, we get like consolidation. Global 525 days, it's a time where the whales accumulate. Of course, also we got like range, we got a local range, and on this example, on a daily time frame, I will show you how to trade this range, for example. So you can see, right? Accumulation, impulse, some distribution, impulse, downtrend. Again, accumulation. And we build a structure, start build a structure. So in this case, this is a break of structure. About a break of structure, definitely I will make another video. So this is a accumulation, this is a break of structure, impulse, breaking out of structure, downtrend, local one, drop it down, and now we form the higher lows. Still lower highs, right? But we break a structure, and now we got the new direction based on seasonality. We have to build the momentum and the structure uptrend. Next moment, how to identify whether the price is in the range or in the trend. First one, in the bullish trend, the price does not break its previous low. So I'll recommend you go and check the video about structure. In the bearish trend, the price does not break the previous high. When we trade in range, the price alternates between the breaking highs and the lows or vice versa. So this pattern helps traders recognize sideways movement. So in this area, there is basically inside a weekly time frame, of course, on a small time frame, there is some structure, local one. But globally, this is a structure, last impulse down, and we trade. Only, for example, the impulse started in April 2022, and only in February 2024, we break of this structure. You know, that's why everything what we trade here, it was just a range. Nothing special. And weekly time frame, of course, guys, like I told you before, I personally also use for accumulation spot position. And yes, it can be even 500 days, 1,000 days, right? Some tokens accumulate, some tokens, the whales accumulate faster, some slower. So it depends of the liquidity, right? And the main purpose. Next moment, it's how does the range form? So the range forms when the price after the trending move. So for example, this is a trending move, correct? This is just a pure trend. Fails to establish a new high or low. So this was a high, this is a low, independent of the trend. It does not break the break of structure. This is a break of structure. This failure signals the start of the range. Any subsequent price movement beyond the range is followed by return and deviation until the full breakouts occur. So this is a breaking out, drop it down below, and this another one, lower high. And next one, it's the purpose of the range. A range serves as an accumulation or distribution zones for large or well-informed players who want to build a position in specific direction or distribute their position. You know, we saw an example in spring 2024, you know, when the whales distribute long-term periods BTC. So price hit new all-time high, then distribution and reaccumulation in the same time, and the new all-time high. And the same story now we trade in range between the 100K, 110 and let's say 79K. So yes, it's just a wider range. The range boundaries are key tools for the market manipulation, as many traders use them as support and resistance levels, placing stop orders or penny orders around obvious high and the lows. I will show you on daily time frame. So how to identify the relevant range? Range forms after the impulse move or a prolonged trend, regardless of direction. So this was a trend movement, pure trend, impulse. The first high or low after the impulse determines the upper or lower boundary of the future consolidation. So this is a main key point. So let's mark it, this one. So we drop, right? Impulse, drop. We identify the K point, a lower K point. After the downtrend, the first low followed by a high is crucial. Next one, we form at the high. So we bounce. So you can find out now. This is just a pure range. So let's mark it like this. Nice one. After downtrend, the first low followed by a high is crucial. After uptrend, the first high followed by a low defines the range. The deviation and the range validity. A range is considered valid when the price reacts to the 0.5 level by FIB and respect its upper and the lower boundaries. So about deviations, many times explained you how it works, and I want to show you on this example on the daily time frame what is deviation mean. We go to the daily time frame. So for example, we can identify, we got an impulse and we found the top. Technically in the moments we can't know this is the last top or not. So after that top we form another one, right? So anyway, how to identify it in a moment. In a moment when we trade here, we can use the FIB. I use the FIB and I would like to show you guys how we can work in a complex with a FIB and 27 zone. Link, I can say, really technical coin because almost till penny react to some FIB levels. So this is what I can identify. Take a look. We got a like impulse top. We use the FIB from this top to the bottom. This one. So technically, let's use like this one. So here in a moment, we identified range. After the impulse, we build the last point, build a support point. The main mistakes of the traders, they use so huge, so big leverages, right? That's why this deviation, it's a stop loss hunt. It's around like, yes, 4% stop loss over this high. And definitely the people who open short here, they hide their stop losses, right? Around here. And imagine with the 10x, even at 10x leverage, it's 40% stop loss. So it's kind of big one, right? But we can use that deviation for our trades. So take a look. Top, support, bounce, deviation. Deviation, it's at that time we can mark with the arc. So deviation we mark in the range like this one. This is a deviation at the top of the range. The valid of range, it's a reaction at equilibrium. Equilibrium, it's a 0.5 level by FIB. And take a look, 27 zone. Now, or not now, that point, it looks unreal. How we can drop, for example, from 17 to 11. Why we have to drop? But on the link, like a great example, 27 zone, you can use like a additional tool also. So we got like reaction, respect the level by body candle close, respect the level 23 level by FIB. Here's a 1, 2, 3 reaction, rejection at 0.5. So we can identify the 0.5 level by FIB. Equilibrium of this range is legit. What we can see next? Next, we can open a long position. So here's we could open. We could not open position here because at the moment we can't know are we going higher or not. So when we stop it here, at this point, we not also open position because we can't know are we going lower or stop it here. But at this deviation, it could be logically to open short position. Of course, it depends of your risk. You can open position aggressively the deviation, but you can't know where exactly this deviation will stop. That's why I recommend you to use a smaller leverage, right? Or a smaller size of position, or open position, after the drop. So when we already form deviation on the daily time frame, but of course we can open position on the 4-hour time frame, on 1 hour time frame, and for example, open here. So the target in the range will be the deviation at the bottom of this range. Deviation at the bottom for us is around here. Take a look how the price reacts and respect. First of all, you can fix some profit, 10% in this example at equilibrium. Put your position at the break even, for example, and leave some percentage to the deviation at the bottom, because this low will be like a magnet for us. What we can see next? Deviation, another one. If we form another deviation, it can happen, right? It's okay. And in this case, we can open another short position. And this is example why we have to fix the profit at equilibrium. So take a look, another deviation example. And we move to the, let's say this one, stop 5% to the deviation at the bottom. Once again, take a look how the price respects the level of equilibrium. This is one more confirmation, so we work in valid range. You can try to catch some bounces on long position every single time when we touch equilibrium, like this one. Yes, it's okay. That's the point, guys. What I told you at the beginning of the video. In the range, we get like 3 points, 3K levels, what we can trade. It's a deviation at the top, deviation at the bottom, like entries and equilibrium, short or long. So what next? Bam. Take a look. So yes, we form it, deviation at the bottom, but we always keep in mind the 27th level. Take a look at the spike. Of course, we have to work in a complex, adjust the news, track what's going on in the macro, everything around. Of course, maybe it was some news at the beginning of January. I can't remember. But take a look how the accurate link work with the 27 zone. Of course, if you add the limit order here, probably you get a liquidation even if you add the 5% stop loss. That's why, guys, I'm not recommend you to trade with the limit orders. You have to wait some confirmation. Or you could add the limit orders at 27 block. And technically, we form a deviation at the bottom. So the range is valid. If we move in uptrend, most likely when we form here impulse, deviation at the top, deviation at the top again, for example, deviation at the bottom, the next one will be the continuation of the trend. After the deviation at the bottom, the priority will be long, continuation of the trend. So that's also keep in mind. If we form at the top, for example, the BTC at 110K, and we form deviation at the top, deviation at the bottom, the priority can be now deviation another one at the bottom, because we're in distribution zone, not in accumulation. So yes, sometimes it's kind of complicated, right? Because if we trade in range, everything depends of the market stages where we now. Of course, if we just bounce it from the long 500 days accumulation and we start build the uptrend structure, the priority in a range will be the uptrend, not a downtrend. So that's the point. Take a look what happened next. Once again, guys, take a look. We respect the 0.5, respect 23. So that's the point how we can work with the FIPS. And FIP works. If we identify the levels correct, you can work with the correct levels and open trade as much as possible local one. Let's say 4-hour time frame. Imagine how many trades you can open here. Take a look how accurate that link. Not all coins trade like link, of course not. But take a look here, 0.5, stop like 3%, bam. You can fix it the next level, so 7% profit. Open short, stop loss at over the first level, drop here. Support at 23, rejection at 0.5, drop to 23. So we can open as much as possible trades. This is what the whales doing in the range. Next step will be probably the test of the 0 level. Bam, 0 level. Also, guys, small tips. When you see some huge spike like this one, in many cases, we come back and close the 50% of this week. The same deviation, the same respect of the level 38 low by FIB, and we move on. Take a look. Once again, hold the line at 0.5, 23. Hold the line by body candle at 0.5. Reject at 78. Take a look. So it's not random. Take a look how the price respect the level 0.5, 86. We stop it exactly till penny. But guys, I identified it works perfectly well on Link. It works even on some low cap coins, but sometimes there is a bigger spread between the ranges. Once again, 0.5, and the priority, it's a long. The priority is a long, and the targets is 19 and 22. So what we could see next? And where we stop? Here, a 1.61 low by FIB. And this line, it's a break of structure what we marked before. So, you know, sometimes it's complicated, right? But it works. Everything what we see on the chart, it's algorithm. And our main goal is identify the correct levels. Take a look how the price respect the 2.61. The most difficult part is identify correctly the first starting points. A range, it can be the really useful time period on the market to open swing position or some, I don't know, local trades. I recommend you go and check the main video about a Link, you know, when I posted here. Take a look how the price respect the level. 18, low by FIB, 38, drop. In this case, if we'll drop again, it can be a return to the range. If the market will build the uptrend, depends of the seasonality, depends of the market cycle, we build a uptrend structure, and it's not a range. It can be the range, just global one, you know, on the monthly thing. Everything should be in complex. That's why, guys, it was a main key point about a range. There is no magic, nothing, but you have to do a lot of back test for your specific coins, what you trade on your specific time frame, and you will see the behavior, how it works on the range. With the practice, you will more accurate will identify the ranges, so you can more accurately open the position for swing trades or for local scalp. Not so often use the auto blocks. I more use to open position imbalance, fair value gap. For me, fair value gap, it's more valid, you know, to open position, and I feel more comfortable when I use the fair value gap. But yes, order block I also time to time use like additional factors to open position. Ethereum USDT 12-hour time frame. First of all, what you have to know, it's time frames. Time frames matter. So we can find the order blocks on different time frames. Order block, it's just a last candle before impulse move. So technically, this is so we got an impulse, trend. Basically, this was the order block, tiny one, but we got an impulse, consolidation, impulse. In this case, this will be order block. Order block you can count with a week or without. We will double check and check which one is more valid, you know. So, but it's only up to you. Also, take a look. This is a 12-hour time frame. So we mark the 12-hour time frame order block. We can add the text to our 12-hour time frame order block. It's OB. This one. So you understand what's going on the charts when you analyze, for example, switch to 4-hour time frame. On 4-hour time frame, this order block can include 1, 2, 3 candles, right? But 4-hour time frame candles. So you have to understand it. Let's go back to 12-hour time frame. And of course, I showed you after the fact, but in a moment, you know, you can also identify it. For example, this is order block, and we go higher, right? The main point, what you have to know, it's a context. So we work with the trend. If we are in the uptrend, so we work with a long position, and order blocks we use like a point where we can open longs. The same way, absolutely, you can work with a downtrend trend, you know, and open short position. So I will show you just longs example, but for short, absolutely everything identical, right? So here's an order block and imbalance. So order block, this last candle before the impulse, should form the imbalance. What does it mean? Here we got an impulse and we got a last candle, we got an impulse, and we form the imbalance. Imbalance, how to work with imbalance and what does it mean, I already posted the video. So here, fair value gap, for example, this one, and we can extend it. Right, got it. So we got a block and we got an impulse higher, and we form the imbalance, this one. Usually we can mitigate or order block, or we can mitigate the fair value gap. That's why I'm more used with the fair value gap. But like you can see, we're not touch even the 0.5 level by FIB. Let's mark it like this one. So you can see we're not touched the 0.5 level by FIB. So we're not touched the 38 level by FIB. So basically in this position, I could not open the position. Right. That's it. And next one is mitigation. Mitigation of order block is here. So we drop and fulfill the imbalance fair value gap. So we can delete it. And after the trend, we come back and mitigate it. How it works, you have to know, first of all, you have to go and check the structure video and the sell to buy, buy to sell strategy. For example, we get an impulse, and the big players and the whales, they control the market, but they need to accumulate as much as possible coins. For example, if we talk about Ethereum, but the same way they can open the two positions, long and short. So here they open this one, short position, right? In this area, they open a long position. And while we go in a trend, they are short position in losses, right? But after that, they have to mitigate their short position and out just in tiny loss or at the break even, right? And continue rally higher with the long. So yes, it's a smart move. You open you accumulated here. You open short position, so people see the orders, people see the volume, people see the bids and asks, and at the same time you open short position and the long position. And this is an order block, it's for long. But after that, you need to mitigate your short position to not lose a lot of money, because they control the market and they can do this one. And what happened next? For example, when we mitigate and come back to the order block, they open position, and here, this is what I told you before. If we count this order block here with like a FIB, here we mitigate almost 0.5, right? If we count the order block with the body candle, you can find out we pass the 0.5 level by FIB and bounce it. That's the mitigation. And this is a point, we can count the order block in different ways. Somebody counts, for example, by body candle close, somebody with the weeks. And there's no right or wrong, right? It's just up to you which one to use. For example, with a week, maybe you will get less trades. With the body candle, you could, open long. Stop losses should be under this low, under the wick of the body candle. It's only up to your own risk, right? And we can write at this bounce. It could be like 14% profit. Let's check. Here's in the moment. Here we pump it even higher. Right, almost 20%, and definitely, guys, 20% not on the spot. Definitely, they can use the 10x leverage or so because they control the market. But you can see the reaction at order block. So it's logical entry. But how to know the order block is valid? For example, let's leave it here. How to know it? First of all, after the impulse, we have to build some liquidity. And here we have to sweep before the impulse. we have to sweep some K liquidity levels. So here we sweep it. This one, we sweep it, right? So we grab liquidity and the last candle before the impulse. So that's a logical one. That's why, for example, this is not an order block. So this is not an order block. This is not an order block. On 4 hour time frame, on a 1 hour time frame, it could be, right? But on this example, I showed you just 12 hour time frame. If we, of course, go to 1 hour time frame, definitely we will find out some other order blocks. On 1 hour time frame, order block is here. So this one. So we zoom in and take a look. Before impulse move, we grab liquidity, form the order block, and push the price higher. Form here the imbalance zone, right? Not touch 0.5 and go higher. But after that, anyway, we come back and close the 1 hour time frame, 12 hour time frame, daily time frame gap. So that's the point, guys. And in a moment, you know, when you see the order block and you understand we are in an uptrend, we work with liquidity. We can work with a structure because it's still, take a look, it's still higher lows with higher highs, right? So we work with a logical long position, and all the time we use the stop loss because take a look what happened next. And of course, we work in a context, and this is what I would like to explain you later. We come back again to order block. Here, we stop it at order block, grab all this liquidity and bounce it. But we change the trend. In this case, we change the structure. And after that, we can work with the order block to open short. For example, this is a order block to open short. Like example, right? It's not necessary, so we should come back and test it, but we go into a downtrend, local downtrend. Of course, it's totally another story, but how to work with order block, how to identify it, I showed you. It's pretty simple, but guys, I highly recommend you work in the complex, right? And in next videos, I will show you some tips how to adjust order blocks to your strategy, you know, and what mistakes so often people do with the order blocks. In this video, we'll talk about the break of structure. So it's a both, like this one. I already post the video about a structure and mark how to work with the structures, and the key point of that work, it's the time frames. So if you work, for example, on 1 hour time frame, you have to work with the break of structure on 1 hour time frame, you know, because it will be valid. If you work on 1 hour time frame and open some position on one hour time frame, long, it can be the still downtrend structure on 4 hour time frame. That's why, guys, work with the correct time frames and work with correct zones. So how the break of structure looks like? Everything pretty simple. For example, we got a lower high, lower low, lower high, lower low, lower high, lower low. And for example, we pump it like this one, lower high, lower low, drop, lower low, and this one is going to be the break of structure because this is the last impulse which give us the last lower high, which give us the last lower low. And for example, we start form something like this one. So this moment here, when we hit the higher point than this last impulse, will be the break of structure. I will show you an example. It can be the impulsive move, or it can be like this chop, bomb, and after that, we can confirm this is a break of structure, and we have to pay attention for the volume. I will show you an example. It's just a visualization. To open position and where to add a stop loss, I will also explain you in this video. So take a look. This is a visualization of break of structure, and we can drop to correction or without a correction. For example, we stop it like this one and go higher. So in this case, this is a break of structure. We can mark both like this one. It was a moment lower high, lower low. And after that, we break the last lower high and form the higher high, local one. So it's going to be higher high. And this one, after correction, this will be the high lows. And we build another structure, right? So we shift the structure. It's for the long. If we talk about this one, downtrend, absolutely the same way, but in opposite, right? So this is a visualization of break of structure. First one, we have to see the structure. A global one, a local one, for example, this is a daily one. I will show it on the daily one. In the range, I'm not recommend you to work with the both break of structure, because in the range, we will see a lot of some fake bosses, right? Because in range, we just work like a chop. We hunt liquidity without the trend. So break of structure, you can use like a trend instrument, not in the range. So you have to pay attention for the structure. For example, what do we can see here? Here's a high. This is a low. Lower high, so because this high is lower than this one. Higher low, because this one higher than this one. Lower high, because still lower than this one. And lower low. Yes, it's like a range, but this high give us the last impulse, and we start build a kind of local uptrend. And this moment was the break of structure, you know. And it's the daily time frame. Take a look. We break of the structure, form the higher high, and retest this structure. Form another one and retest. So this is it. You have to pay attention for the time frames, structure, time frames, last swing. So this is a last swing, last impulse down, which form the last support and break. So where to fix a profit? Fix a profit, you have to add some for example, this is a sol, you know, at first trouble area or favorable gap. So here, it's a break of structure. You could fix a profit here. Some profit here. Stop loss, you add usually at a last impulse, this one, you know, and we can right to the top. You can open position on the break of structure, you know, with retest or without retest. It's only up to you. There's no rules, you know. Everybody trade if it's comfortable for you, because everybody got to own risk, right? And you can find out just millions of videos about break of structure. But if we simplified, you have to know just a basic structure in the uptrend. You have to pay attention for the time frames. So on this time frame, daily one, this is a last both, drop, break. Most likely here was a volume. Here's a nothing, and here's a volume, this one. So this volume is bigger one than all these previous days. Here was another impulse. So we break the structure. From the break of structure, we got like 36%. So with even the 10x leverage, it's 360%. So it's a big deal, guys. And after that, we form the new high, drop, form the new low, and this will be the boss break of structure for the downtrend. Form the new high, and it looks like we have to go in higher in the uptrend, but we break the structure downtrend. The same way, you can open the short position, for example, like this one. And it was a good entry, like 44%, 40% down. So that's it, guys. And don't need to build a so crazy, complicated explanation about break of structure. Break of structure is just a time when we just shift the trend. It can be a local one, 1 hour time frame, 5 minutes time frame, 15 minutes time frame, 30 minutes time frame, even a 3 minutes time frame. So it's only up to you. Smaller time frame, you will see the faster change of the trends intraday. So on the daily, it's not so often. This is a simple visualization of break of structure. This is example. So guys, I hope you like this video. Write please in a comment if you get any questions for breakup structure. Maybe I will post some tips how to work, how to identify more clearly that breakup structures, but time to fix profit is favorable gap or first trouble area. And this was the first trouble area, previous high and previous all-time high. So it was a logical exit point, right? And this is support. It's definitely some of order block on a weekly, or here was a drop to the order block on a monthly. So this January 24 block, it was a order block on a monthly. How to work with order blocks, I already also posted the video. Breaker blocks. Let's dive in. This is going to be just a quick video. In simple words, I will show you the greatest example. What happened recently on a BTC, a 5-minute time frame. It was amazing example of the breaker block. First of all, I highly recommend you go and double check 2 previously posted videos about an order block. So guys, order block is here. This is a 5-minute time frame. Everything would happen on 5-minute time frame. You can find maybe on the chart on 1 hour time frame, 4 hour time frame, 12 hour time frame, daily. So it's just patterns, right? Take a look. This is a order block. So the last candle before the impulsive move, right? It can be the bearish one or bullish one. So this is order block. We count. Somebody count with weeks. Somebody count just the body candle where more volume traded inside. I usually use just body candle. Like a small tip for everybody who love trade order blocks, retest of order block for opening entry. It can be long or short. It's 0.5 test. So we use the FIB and here, perfect test. We got a candle. Next one candle absorb all this previous one candle and especially the body, absorb it, drop correction, get a reaction at 0.5 level of this order block, and it's good time for entry. Stop loss here you could add on the week. So it was an amazing basically trade with 0.03% risk and gains like almost half percent. So of course, if we talk about a second leverage, it's not a big deal. It's only 1%, even less the profit. But for this scalp trade, you can use it like 20x, 25x, 50x, because the stop losses is really tiny one. All right, so we formed the blocks. This one, order block. This is candle. This is a breaker. So the logic is, in many cases, we form the order block, retest, going higher. So we talk about a trend. But the breaker, it's immediately change the trend. Usually when we form the trend, we can come back, test some order block or imbalance zone, test it, bounce it, and going higher, continue rally. But with breaker block, we test the order block 0.5 level by FIB, bounce. If we not grab liquidity or sweep the liquidity, we form the correction, and the one big candle with the volume just crash it down. Usually it's happened at what I found. Usually it's happened on some key moments inside the session or on some news, right? So we crash it down, and this breaker block, full candle with the wicks, it's called the breaker block or breaker. The entry to open short because we break down, we have to work in a complex and zoom out, double check. Are we found a rejection at some level? Or it's a top of the top? Because in the current moment here, we can't know. We will not see something like this one, right? That's why when you open position at a breaker, you have to work in a complex and define more reasons why it's okay to open short or long, depends of the direction, at this block. That time it was logically to open short position because it was the middle of New York session. We break the order block, form the support, and come back, test 0.5 level by fib mostly. Now I will double check 0.5 of this breaker. For me personally, and I guess for you also, this breaker looks like imbalance. Yes, definitely. So we formed the fair value gap. One candle, second one, third one. So we formed the fair value gap. And the entry can be at 0.5 here. Perfect test. So it was an amazing example just recently what I found on the chart, because I remember that moment. And the stop loss should be over this high. The main and the closed liquidity pool. In this case, it was so amazing. Could be so amazing trade because the stop loss 0.5% and the potential was pretty good one here. 2%. With the 50x, it was 100% profit. Amazing trade. And the logic, amazing and the logical one. After that, guys, take a look why it's risky. Why it's risky to not fix the profit and wait. We come back on the next day. We come back, test again, and form basically the new high because we close the breaker and sweep the main high and liquidity pool, because the liquidity personally for me is a key. Anyway, guys, this example, this is an amazing example like from the books, right? And second time, I'm not recommended to open again trade because if you open here logically, the second one most likely will be with a stop loss because the main direction on a BTC is uptrend, right? So you have to work in a complex, zoom out. It's a 5-minute time frame example. That's why on a 1 hour time frame, we're looking uptrend. On 5-minute time frame, it was a local scalp trade inside a day from breaker, retest, take profit based on your risk ratio and proper money management stop loss. Of course, you could open again short here, the same, but you could fix the 0.43% profit if you could fix it. And get a stop loss if you're not. It's buy to sell, sell to buy. How the market makers manipulate the market, how they deliver the price to the right target, and what they do, and how you can find the steps of the market makers or the whales or the soft or the bots on the chart. So let's dive in. Everything what we see on the chart, it's just soft bots from the market makers. Everything what we see on the chart is programmed before, and the price of some assets will be delivered in the right time, in the right moment, for some reason, and the news just deliver the price faster or slower. So this is a classic model, really popular. It can be on the 1 hour time frame, on 5-minute time frame, on a 12-hour time frame, on daily time frame. Intraday, you can find these patterns in a complex with the sessions. A lot of times I found that model before or after the news in the United States, or before some release of Fed decision rate or FOMC meeting minutes. It's classic. I want to show you just this current situation on a market with a BTC. It's a 12-hour time frame, and it's at this current moment, it's so classic, especially at the buy to sell. First of all, what you have to know, it's time frames. If you trade on 1 hour time frame, you open position on 1 hour time frame, and you count your stop loss 1 hour time frame. You have to take a profit on 1 hour time, because a lot of people made a mistake. So they open position on 1 hour time frame, but after that they wait the take profit target on a daily time frame. Or for example, you open position on 1 hour time frame, but wait the target like imbalance on a daily time frame. It's absolutely wrong trade. You will get your stop loss or liquidation. So time frames matter. On this example, I want to show you on 12-hour time frame. Only on this one. You can adjust and find absolutely the same models on different time frames. So it's just a fractals. First time, it's buy to sell. So what does it mean? On this chart, this is an all-time high. It can be the all-time high or some high of level. It can be the previous day high or previous day low, previous session high, some K level where we stop it. It means over this high, we got a lot of stop losses. So it can be like around 1%. stop loss. 1% stop losses, it means with a 10x leverage, it's 10% losses. And it's kind of big one because it can be the big one because imagine it's a BTC and there's a lot of stop losses. In general, I talk about a heat map, and the liquidation heat map. And you can imagine a lot of traders open position with 20x, with 50x. So it's multiply the stop losses. That's why this hunt of liquidity looks logical. How to deliver the price higher, but after that, liquidate them. It's pretty simple. It's buy to sell model. We can use only the one indicator, it's volume. We go into correction, everything good. So we hunt this liquidity, this one, and going back. Before we hunt liquidity, we showing us the direction down. Everybody think, no, we go into correction. But after that, with a huge volume candle, the buy to sell model, we always on the big volume, push the price higher with a big volume. So here, this is we go higher, but a decrease in the volume. This one. On the last candle, on 12 time frame, we push higher price, so like crazy, with a huge volume, like never before. Here, push the price higher, grab that liquidity, and you have to understand, the market makers not press buy by market one time. No, they, they use like a grid. They accumulate positions step by step. And here, they accumulate, for example, at 101, here 104K, 107. So the average entry is around 104K, this one. They open long. Yes, they open long position and push price higher. Retails this time think just by classic TA, we break all-time high, or for example, or some high. We have to move like this one, breaking out the top, retest and go higher. Continuation, but it's a trap. But you have to work in a complex. Not all the time it can be the trap. Open long, but after that, they open the same time the hedge position down, this one. And take a look what they do next. In the moment, they temporary in losses. Their long position temporary in losses. Yes, guys, it works like this one. But here, they push price buy to sell. They imitate the order flow higher. They push the price higher with a big volume, big orders. Push the price higher. After that, they open position short because they got a lot of money. They can manipulate the price. They hedge. In this area, all these guys are liquidated, right? In this area, they stop. For example, just example, they stop. It can be here, it can be here, and mitigate their position back to their entry to out at the break even. But they already hunted liquidity. And after that, they work in a profit. So yes, they can close the position in, for example, like, I don't know, in a moment, it was like 6% losses, temporary losses. But after that, they mitigate position. For example, they can close the position in 1%. They cut that losses because of buy to sell model. They deliver the price 15% profit. The key point on the buy to sell model, it's some K level high or low. On a sell to buy, it can be the low. On buy to sell, it's some K level top where we hunt liquidity. Where, for example, on 12 time frame, the price should stop. In this case, we have to work like with additional tool, with some factors where we now globally on a monthly time frame, on a weekly time frame, where we now on a daily time frame, where the main zones of support or resistance, where the main imbalances, because in this case, we dump it exactly to close a weekly gap. It could be the monthly gap. So, where we stop after buy to sell model, it depends of context in general. In this case, we have to fix the profit on the next trouble area, right? So on the next some K level. So don't be so greedy. When you found on 1 hour time frame, I repeat, when you trade on 1 hour time frame and you found the buy to sell model, you open position, buy and then sell. You have to fix the profit with your risk management, risk ratio. So don't be so greedy because sometimes you can do everything right, but you wait some 15% profit with 20% profit, but it could be like only 7% profit. The same story with sell to buy. The price dump it. In this case, we close the 50% of the weekly gap. Price bounced with a huge volumes from sellers, right? We bounce back, and the whales and the market makers, they by greed accumulate open short position. It can be like 86, 82, and dump at 78. So they open a short position. Average entry can be like 82, for example. And this is an entry around 82K. Price dump it. Retails most likely see the seller pressure, the big volume, start thinking, so we sweep it the low, we have to bounce and drop it lower again because we build the order flow, right? But what the market makers do, they open position here because they know before where the price will stop. So they open position here with a stop loss and we go higher. And when we bounce it here, they mitigate position, cut some losses on short, right? And ride with the profit. Ride with the profit, let's say 14%, just approximately. And again, the main factors should be hunt some K liquidity level, work in a complex on a higher time frames, and the volume. Now, like you can see, the volume decrease from buyers. That's why it would be logical to see this drop and go upside move, because the people now still in short position. Take a look. This is a classic also buy to sell, sell to buy model. So here we hit the top, some K level. Got it. So we dump it. This was a sell to buy. After that, we push the price higher, and it most likely was the news. This is what I tell you. Especially sell to buy to sell works together with the news perfectly. We grab that liquidity. For example, they can open position here, here. So in average here, like this one. Let's say like this one. They push price higher, right? We grab and hunt that stop losses. Everybody waiting something like this one, continuation, but the market makers know what they do. And for example, they can cut their losses, right? Like, I don't know, 2%, this one, cut their losses. But after that, they can get the 11% profit and volume from sellers. This is a classic model when we grab liquidity and dump it immediately in opposite way. In this video, I want to talk about a smart money reversal trading model. Let's dive in. First of all, guys, we're going to use the smart money concept terminology like HTF, SMR, breaker, break of structure, bows, and all of this stuff. But guys, you have to know it's just a name dropping from smart money concept terminology. You can name just up to you all these things. The main logic, you have to understand what you mark on a chart. The terminology, what people use from smart money concept is just a basic terminology. The logic didn't change because on the candles, everything looks absolutely the same. And even if you call the breaker, not a breaker, but helicopter, and you will understand what the helicopter mean, personally for you, you can trade it. You can understand it. Right? Because a lot of people make a lot of videos, a lot of courses and change the terminology. So their courses looks more attractive, more professional. But guys, the charts, it's just a simple charts and the name dropping didn't change the logic. Anyway, in this video, I will explain you with the smart money concept terminology. So it will be maybe more easy to understand and remember it. Take a look. We have to pay attention on the left side on higher time frame point of interest. It can be HTF POI, previous day high, previous week high, or I don't know, the monthly all-time high. Just like example, K level. And we have to sweep liquidity. In this case, I showed you the uptrend. The same way we can use the downtrend. So here we get an uptrend. We form the boss. So this is the last impulse, which gives us the new high, new next point swing. We sweep the high time frame point of interest, grab that liquidity. This point will be now SMR, smart money reversal. And here we got drop, bounce, form the favorable gap here, because of course it's 1 hour time frame, but for example on 30 minutes time frame we can be formed the favorable gap because of breaker. About the breaker, I highly recommend you go and check somewhere here the link to check that video. We drop, bounce, we can retest some of the level of favorable gap, drop it down, break the structure. So when we break the structure, also I highly recommend you go and check the video about a structure. At that bounce, we can stop at 0.5 level by fib, the favorable gap, or 61, or even 78, for example, and we can open the short position because we get reasons, right? We sweep the previous high, we sweep the liquidity of high time frame point of interest. One reason. Second one, we break the structure. Two reasons. We test the favorable gap. Done. We close the 50% of the breaker. 4. And we can open position. It's a logical entry. Is it possible so this entry can be wrong? Yes, absolutely. Here, for example, by logic, we can open position here, stop loss at over than previous high time frame point of interest, right? Or over than SMR. But it's possible to see even like this move again because of some news. And guys, you have to understand on the visualization, everything all the time in theory looks perfect, but in real life, it can be something like this one. And grab your stop loss. Yes, it's more than real. More than real, absolutely. Especially on the low cap tokens, we can form something like this one. Even the break the structure, form the wick and going down. Or before the news, or after the news, or some rumors, or some macro. Guys, in theory, you have to understand all YouTube channels explain you perfect entries. But on the practice, in real life, when you trade with the real money in present moment, it's a psychological pressure, it's emotion, it's a news, it's some tweets, a lot of factors can affect the price on any token with a week and grab your stop loss. So this is a not 100% win rate strategy. So this is a visualization of the entry and the logic. Logic, I explained it. Where to fix a profit? Fix a profit you can at break of structure. After that, when you fix some profit, you can put your stop loss at the break even and move down to the next zone of interest. For example, it can be the consolidation, it can be some accumulation zone here, it can be the favorable gap, something like this one, or the block. Got it. So this is visualization. This is a real example on Sol, what we saw recently. So here, for example, we formed the high. May 14, we formed the high in Asia session at $182. Got it? We crash it down here, start climbing up. So this is an uptrend, like on a visualization here. It's 1 hour time frame, by the way. Here we climb it up. Here was the last boss, for example, or this one, impulse. We sweep the high, form correction, form the SMR, right? Because we closed the candle over then high time frame point of interest. Here, this is going to be the SMR. Here we form the breaker, crash it down, break the structure. After that, we bounce, test 0.5 and 38 level by fib. Here we can open logical short position. Short position can be at 0.5, which can be kind of bigger stop loss, or at 38 with a smaller one like 2.77, or a stop loss you can add it's a little bit over than full fill of the breaker, 1.62. Depends if your stop loss, you can count the proper size of your position. And I notice this model usually form at the end of the session or inside the session, but when we sweep the high time frame point of interest of the previous K level. It can be the previous day high, previous week high, previous month high, all-time high, or something like this one. Vice versa for the previous day low, previous week low, previous month low. So guys, this is example. Highly recommend you take a screenshot of this model for entry. Maybe I will share this visualization on channel, Telegram, totally for free. And this is a real example of entries Sol USDT example on 1 hour time frame. But guys, you have to work with that specific time frame where you find that model. Also, you have to keep in mind there is no 100% guarantee you will not get a stop loss, because on a theory everything can be so amazing, so perfect, like in a book, right? But at the end we can get a stop loss. So work with proper money management and risk management at any of these trading models. First of all, compression is a market condition where the price begins to narrow into a really tiny range, or some tiny uptrend move, or in some tiny downtrend move. Market makers build a liquidity. If you look at the chart, you will see the series of low highs and the high lows. It's like a spring coaling tire and tire, preparing for the sharp movement either upward or downward. The main question why compression is happening. It occurs due to the balance between the buyers and the sellers. Everyone is waiting for the moment when the direction becomes clear, that is breakout. So think of the price at the compressed spring that's about to explode in a specific direction. What direction? Unfortunately, at that moment, we just work with possibilities and they can't know which one direction will be for sure. Here's a few examples of compression. In the simple words and a simple example, it's just a basic trend line. For example, this is a BTC on a Bybit 4-hour time frame. I use the reply bar to show you just example. So here, what the majority of traders do in this way. First of all, you have to work in a complex. And if we form something like this one, so we grab liquidity, bounce, and start build a compression. Take a look. Touch, 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 touch. Every single touch is somebody open that long position. This also can be identified like a channel. We can go in higher or we can drop below under this compression. And we can't know in a moment when will be the last touch and we drop it down, for example, because the traders who open the long position on this touch of support, they also open a long position like this at stop loss under the last low, for example, 0.75%, and wait the continuation on 4-hour time frame. And then we drop it down. So their position liquidated. It was just a compression on 4-hour time frame. Take a look. If we build the compression on 4-hour time frame and we breaking out down, the people start open short position. But if we zoom out, for example, on 12-hour time frame, compression where we build here, 1, 2, 3, 4, this line. So all of that highs till even this one closed. After that, some traders start form another pattern like head and shoulder, and the size of that pattern should be around here. So it's totally another story. So I recommend you go and check a free video about a head and shoulder. So this is one way about a compression on different time frame. Also, compression can be like a range. And when we build the range, you can use the ATR indicator. It's a average true range. When you see, for example, when we trade and you see the volatile going down, it means sooner or later we will see the breakout. Here, we go in higher, form almost deviation at the top with again low ATR. And bam. Volatile going higher, average true range going higher, we're breaking out of this range. It's just on the daily time frame. One day we'll just realize everything what we saw on the BTC, it was just one global range compression on the monthly time frame. So take a look, the great example of compression on BTC on 1 hour time frame in December 2022. So we use the Bollinger Band, December 23, 4 p.m. The price is 16K766. Got it? Next 2 days till December 25, 4 p.m. we trade in the range 0.58%, so less than 1%. It was like $100 range for BTC compression. So it means sooner or later we will out of this range. Here's some tips about a compression. First of all, you can identify the K levels. K levels in this case was the test and the close 50% of 1 hour gap. We got an impulse, come back. So this is a K level. And after that K level, we build a compression. So mark that support, this like support level, and resistance. Resistance was this top. Next step is wait for the breakout. The confirmation of the breakout, this could be the strong candle with a high volume. In this case, we have to use the volume indicator, and we can identify here. We sweep liquidity, and on this candle, we can open long position, for example. Of course, all the time you have to use the stop losses, right? And trade with a trend and watch the volume. But you have to understand, if we trade in the trend, mostly we will continue the trend direction. But if we trade a long time period in the range, most likely we will see not a continuation, we just will see the sweep of liquidity, like it was here on this example. Don't enter a trade before the breakout. Compression can be last longer than expected. So yes, for example, like here, so compression on 1 hour time frame is good, but if we zoom out, it's just compression on maybe 4 hour time frame or on a daily time frame. Next tip, it's don't ignore fake outs. Sometimes the breakout can be deceptive. Look for confirmation. With impulse, we go in higher, because everything should be in complex. And of course, don't risk your entire capital on a one trade. Always stick to risk management rules. So guys, this is just a few words about compression. AQL highs, AQL lows, it's just some levels what we can just name it, like this one, AQL lows or AQL highs. So it's just like tool what we use to identify the level. Some people who trade a classic TA don't use it this terminology like AQL highs or AQL low. They use like support, trend line, and all of that stuff. And the main problem is for people who trade classic TA, right? So they use this level like support, this level like support, this level like support, and they think, because it's in the classic books, while we find some support and bounce, it means this level strong. We retest it again. This level much stronger. The third touch is 100% support level, so we will never drop it lower, because we all the time see the support. It means the buyers are ready to buy at any drop. But guys, the problem is the more we test some theory level, this level become weaker, not stronger. And it's only the matter of time when we will drop or pump and sweep the liquidity. Mean hunt stop losses. Higher time frame, the more liquidity concentrated under this level. So AQL highs and AQL lows are liquidity pools where the highest concentration of stop orders is found. Typically, the AQL highs and AQL lows are the result of artificial liquidity engineering. So guys, I always repeat, everything what you see on the chart is just built and formed by algorithmic bots. Yes, you hear a lot of stuff about ICT concept, smart money concept, but guys, ICT just give the names of that levels or that tools, you know. The S&P 500 is traded by these bots during the last, I don't know how many years, right? They traded. So now the crypto only 15 years like exists, and I already explained to you, it's impossible to trade all of that coins every single day without a weekend on even 10-second time frames manually by hands of traders around the world. All these levels are designed to serve as motive for stop order rates in the future. So in simple terms, the price usually aims to clear liquidity above or below this level. The retailers who trade by box, they always think when we got some levels, it's like support, and the next level is resistance. But believe it or not, in most cases, sooner or later we drop and sweep this liquidity pool, because under here, somebody buying here, add stop losses here. We drop it down. He buying more or new order, stop loss here. 1%, 2%, 5%, no matter what. It's cross margin, isolated margin, spot, absolutely doesn't matter. Third time. So with this move, we're going higher. And while we drop, mostly people will open short, because in retail's mind, if we lost some level, it means we shift the trend. But that's also a mistake, because we just hunt liquidity hunt stop losses, and their stop losses, it's a fool for going higher. So that's a deal. Or the second option, we can leave here actual lows. In this case, it's a when USDT trading pair, and going higher. But after the years in the next bear market, for example, after the new all-time high like this one, we can drop and hunt that liquidity, because everything what you see on the chart is just algorithmic bots. We'll leave the liquidity, and sooner or later we're gonna hunt this liquidity. To mark these levels, I use just a basic line, and I recommend you to create a template so you can mark actual highs, actual lows. How to work with the lines, I already posted the video. 5% tiny stop loss will be more than enough to liquidate these guys. 5%, 6%. But it can be the big concentration of liquidity. It's not some one position of some one trader. No, it's just a tiny level. But there's millions. There's million liquidity, money. And it's more than enough to make a move like this one, grab all of that millions and put the price higher. This is example of actual lows. It's a great example. Also, you have to understand the weekly time frame actual lows, it's like a big magnet for the market makers in the future. So for example, if and when we leave the actual lows like here on BTC. So here, we leave it. For retails, 28K, it was a strong support level, historical level. They found a million explanation why exactly 28, 30K. It's a crazy support level, which will never breaking out down because we never drop it below previous all-time high. It's Elon Musk level. He purchased BTC here. It's Michael Saylor level, blah, 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 all this stuff. And then we just, after it was made somewhere one, and just after the year, we just come back and sweep that actual lows. That's a point, guys. And leave here the actual highs. So after also the 3 years, come back and sweep that actual highs, because a lot of people add stop losses here or add the limit orders to sell here because they need to out at the break even. Everything should be in complex. If we trade around the K level, a lot of people use the same FIB, understand the market, and they can add here the limit orders to sell. Limit orders to sell can be like also fuel for continuation and liquidation of that, guys. So we go to 4 hour time frame. Here we form at the top, another top, and we form just a local, let's go to 1 hour time frame, local actual highs. So above these levels, someone stop losses, and something like here around let's say 5%. Got it. What the market makers do the next? Why we always around some K level going like in a sideways? Because the market makers need to build liquidity, and we going higher. Bam. We sweep it, these highs on 1 hour time frame. After that, when we sweep it, we see the reaction on 1 hour time frame. On 4 hour time frame, we form it another actual highs. So that guy's liquidated, this guy's created. The people again open it short, add stop losses, and wait the correction. Bam. Again, liquidated, that stop losses, and almost touched the penny 2.61 level by FIB. And sooner or later, we go and liquidate that 12 hour time frame stop losses. So this is a way, guys, how the market makers hunt liquidity all the time. But you have to understand, if some token, for example, like DENT, formed some actual highs on a weekly time frame, it's not 100%, so we will come back and sweep that highs. Depends of market capitalization, depends of how many tokens inflow into the market with the unlocks, with supply. So technically, we can sweep that highs, but everything should be in complex. When you see something like this one, most likely you can be sure if the token relevance still exists on the centralized exchanges, the people trade it, there's volume on this token? Yes, most likely after the 3-4 years, we will come back and sweep that highs. Liquidity pool. The same story happened with XRP. I will try in simple words, on simple visualization, show you the main things what you need to know about liquidity, so even the beginner will understand it. So yes, this is just a simple range on 1 hour time frame, and this range will be more than enough to show you the main key points of liquidity. Of course, you can find the millions videos, the millions blogs and articles about liquidity. I would like to show you just in simple words. So this is a range. Every single week or body candle close, it's someone stop losses. It's orders to buy and we're going higher. So it means the people add stop losses here. So here's example. Here we took a long position. Someone will add stop losses with leverage or without leverages, like here 1%, less than 1%. Someone adds stop loss and right to the top, for example, fixed the almost 7% here profit with 1% stop losses. Someone short positions the liquidity and the fool to put the price higher. Orders, stop losses, shorts, trigger it, it's become the fool for longs, and vice versa. I showed you on 1 hour time frame, but if we switch to 5 minute time frame, you will find out more and more candles. But people use the so high leverages. Take a look. If we turn on the trending lines here, just 2 main trending lines. So just imagine here's a body candle close, November 17, and someone add a stop losses here. So open long, for example, open long here. Got it. And add stop loss under this week, 0.83% stop loss. With a 10x leverage, it could be like 7 or 8%. It's pretty big one. And if all this range bound not took a profit and wait the price higher, at the end, his stop loss, hunt it and trigger it here. That's why it's hunted, trigger it, and bounce it back. To hunt stop losses here. That's why, guys, it's not when you hear the market makers hunt liquidity, the market makers hunt your stop losses. It's not market makers, it's algorithmic. Algorithmic bots see where the main liquidity concentrated and just walk from one pool to another one pool. Also, take a look, the great example of actual lows, actual highs. So this is actual lows. Here, this stop losses, and this stop losses. And at the end, after a few days, here we hunted, after 3 days, we hunted this to one, and after we hunt this one, or form another actual lows. So it means sooner or later, guys, just you can be sure, we will come back after maybe new all-time high, we will come back and sweep this liquidity pool. Because under this week, someone stop losses, and under this week, someone stop losses. And here's a visualization, how it works. Under this stop losses, always just a small fish. So it's you, me, and other small retails. Yes, we are all retails. And when in Twitter, you can read from that experts, oh, retail's back, they never gone. Because retail's always in the market. We are all retails. And this week, it's a trap for retails, which one float here and think and dream, oh, I opened it exactly that long position, which will never be triggered with a stop loss, and I will be the millionaire. Because we skyrocket to the moon. And a lot of people open at longs, not with a 5x leverage, with 10x leverage. The people use the 50x. 50x, 75x, 200x leverages. It's so easy. Liquidate this guy, this guys, this guys, this guys, this guys, this guys with this tiny wick. So this is how it works. And all of that fish, it's trapped, and we can ride to the top to trap another fish. This stop losses, and like you can see here, tiny sweep. Here, tiny sweep. So it means, yes, also this stop losses is triggered. So sometimes in my videos, you can see these things about deviations. When we trade in the ranges, so often we form deviation at the top. So sooner or later, we will come back and sweep that top and form deviation at the bottom. So it's some level which will be triggered. In most cases, if we form deviation at the top, then at the bottom, next one will be at the top. If we are trading in uptrend, if we trade in a downtrend, this is deviation at the bottom, then deviation at the top. Next one will be continuation of the trend down, and vice versa to the uptrend. So this is a great visualization how the algorithm hunt the people stop losses. And everything what you see on 1 hour time frame, you can find on ranges or in an uptrend or in a downtrend on 4 hour time frame, on a daily time frame, on weekly time frame. And the high time frame, the more liquidity under some level. Some instruments, what really important for me when I work with liquidity. First one, it's a daily, weekly, monthly, yearly open. This one. I already made a video about this indicator. It's totally for free. The weekly open level is also can be the trigger for liquidity. And like you can see here, it was November 18. And after 3 days, we come back and test it. The same story will be with the daily open. So this was a daily open. K level, we drop it down, hunt all of this liquidity and going higher. So now these levels can be like a triggers to test it again. What's going on later? We going higher, format another daily open, but a weekly open still relevant. And take a look after the few days. Here. This was a weekly open of previous week, this one. And we hunted liquidity. Here, we sweep the stop losses of previous week open, retest it, and going higher. Next level will be the bullish one of daily and weekly open, but uptrend. So this is how we hunt liquidity. Another also indicator, what I use, it's a market session. You can use any of that market session available indicators on TradingView. You can adjust by colors. I already posted the video about this indicator. Also, it's totally for free. So this is a liquidity pools of sessions. When you see the Tokyo session format the high, it means the London can sweep that high liquidity pool. Then take a look. We format the low of New York. After the few days, we sweep that low in New York and in Tokyo. Session of London in November 18, and after 3 days in New York, we come back and sweep that liquidity pool. So you can use the liquidity sessions pool intraday, or you can work with the swing trades on 4 hour time frame, for example. So this is just a simple example and simple visualization how liquidity looks like on a chart. And our main goal is not be trapped in this net. I think you heard about different trading style and you heard about the swing trading. Today I would like to just show you the simple example what swing mean and some small trading tips which will be useful in your trading journey. First of all, the swing, it's a 3 or 5 candle pattern. This pattern informs the trader about reaching the price limit in a given time range, some time frame, with a further price reversal in the opposite direction. And you have to understand, so the timing in the swings, it's really important because we can find some swing on 5-minute time frame, but on 1 hour time frame, we will trade something in the middle. As we can understand from the definition, searching for swings makes sense when we're forming patterns of 3 or 5 candles. We will learn to identify them. 3 candle swings or 5 candle swings, it's a pattern informing the trader about a price reversal by means 3 or 5 candles that met the conditions. Just on 3 candles example. 3 candles on a given time frame must be located sequentially, that is, follow each other. The middle candle of the pattern, including the wick, form the highest or lowest point of the pattern. The color of the candle bodies in the pattern absolutely doesn't matter. And the wicks of the candles should always be taken into account. This is how the 3 candle swing looks like. The wick can be way higher, for example, like this one, and the body can be like this one, and the colors absolutely doesn't matter. This is a bullish swing. The bearish swing will look like this one. By nature, the swing can't give you exact entry. So it's just a pattern, formation of potential reversal movement, and everything depends on time frame. But the swings give you the information where you can add your stop loss or where you need to take a profit, like this one. I recommend you do the back test and try by yourself identify the swings on different time frames and try to open trades on a simulator with reply bar. And the higher win rate will be when you will open trades on the swings on some K levels. It can be the sweep of K liquidity. It can be the sweep by this swing, some high of previous session. This swing can close, for example, like 50% of previous fair value gap. All of that swings should have logic, not just in the air. So you find the swing and you open all the time the trade. No, take a look, just a few examples of logic for swing. Here we form at the top, October 18. And after that, with the swing, we sweep that high. 1, 2, 3. So this is a swing. And at this area, we got a logic of entry because we sweep it the previous high. The target of this trade will be sweep of this swing, this one. So this is like a under liquidity pool. This is previous swing, 1, 2, 3 candle. But for example, if we form a 1, 2, 3 candle, fourth candle here, we open trade, stop loss over then swing, 1.5% stop loss, take profit here, 2.7. Sweep of this one. We should close position. Here's an example of a swing and open trade with a fair value gap. So here we got, let's say, 12-hour time frame, fair value gap, this one. Let's go to 4-hour time frame and we wait at the entry to open short. Of course, based on news or not, it doesn't matter, but we form it 1, 2, 3. So on 4-hour time frame, we close over than 50% of 12-hour time frame fair value gap, over than 50% of 4-hour time frame fair value gap. We form the swing and we could open position. On 30-minute time frame, of course, it looks like this one. 1, 2, 3. We could open position even here, stop loss over then swing, take profit is this low. What we leave it in November 1st. And we sweep it this low with 2.9% profit. Also, at the beginning, it's maybe will be kind of difficult to identify the swings and work with the zones, but that's why I recommend you to use this free indicator. It's the wicked fractals. So this indicator just identify the swings. It's not showing you the entries or exits or stop losses or trades, entries to open short or long. No, it just showed you the swings. You can't trade just by these dots. No, these dots format after the fact. You know, it's showing you this is a swing. And after the time, it will be logically to sweep all of that swings. So like this example, 1, 2, 3, we format that swing. On 4-hour time frame, it looks like this one. 1, 2, 3. Here's a swing. This is not swings. So between all of that candles, there is no swings. Of course, inside a 5-minute time frame or 15-minute time frame inside this block, you will find a lot of swings. But here's a 4-hour time frame, another swing. 1, 2, 3. This is a swing. But of course, only after the fact, when this third candle will be closed, we will see this dot. In settings, you can use 3 or 5 bar fractals. Basically, I use 3 because for me it's enough. No makes sense to use 5. But if you wanna, you can use a 5. Like you can see, some of them disappear. And of course, if you trade on 4-hour time frame, here we format the swing, this candle close, and you could open short, but with 3% stop losses, it's kind of risky. Have a chance to see something like this one, to sweep this swing. That's why, guys, work with proper risk management and work with your time frames. Also, take a look on 5 minutes time frame. There's a lot of swings, but it doesn't mean you have to trade every single swing or open position at every single swing. You know, it's absolutely no make sense. You have to work in a complex, build a logic why exactly this swing can be the entry or take profit. 1, 2, 3, this candle close, we form it and confirm the swing. But no makes sense to open the trade on 1 hour time frame here after the candle close. So it was like a risky trade, and now you could be in losses or at break even. That's the point, guys. But of course, on 15-minute time frame, there were better win rates. So 1, 2, 3. We close 50% of 12-hour time frame favorable gap. We get some news. We open trade when the candle closed, 0.5% stop loss, and the target can be this low or this low. Up to your own risk management. It could be like 3% trade. In this video, I will talk only about how to use this tool, how to adjust the settings. And in the next videos, I will share with you some strategies, how you can build, how you can combine EMA and with other tools, combine and build a real strategy, how to open, how to close position. EMA, SMA, WEMA, SMMA, it's just the tool. And all of them show you pretty same data. I personally use mostly EMA. Not so often, but yes, time to time I can use it. And I have to say this is one of the not so many really useful tool. And with this line, just simple line, you can build a strategy. Real strategy. Of course, depends of your proper risk management, money management, and of course, you have to work in a complex. When you use some tool, you have to understand what exactly this line now on the chart showing you. Because a lot of people, when they add some indicators, add some tools on the chart, they totally don't understand what exactly this line showing you. That's why even by name, you get understand of the moving average showing you that some average price by some time period. To add EMA onto the chart, you need to just go to indicators, type EMA, and choose this one, moving average exponential. You can add to favorites. Why the line on the chart? Exactly here. You can adjust settings up to you. So guys, everything absolutely individual. Most popular line numbers, what people use, what trader use, it's 20, 50, 100, 200. It's a days. So we go in settings and adjust the length will be 50. Just for example, 50, I mean, I would like to see the average price by candle close last 50 days. Here. That's it. So we multiply all of that 50 candle close price and divide 50. And in this case, the average price of all of this 50 days on Sol USDT, just like example, now is 155. And the logic of this line is the same like with regression channel. So the price always wanna come back and test the fair price or average price. So for example, where we're going way over the line, we always wanna come back. So we drop it way under, we always wanna come back. Way over again, and we want to come back. And you can use it on totally different time frames. You can find how the price sometimes reacts and respect the line here, because we come back to the average price of some time period. So here, this is a daily time frame, we test it. Then here, we test it like support. The line can play out like support or resistance. So for example, we can go to 4-hour time frame, and even now you can build some plan. So let's say when the price rejects the line, I open short. So here it was a short like 6%. But the problem, you don't know where to fix the profit. Then, for example, you build a strategy. When the price bounce and tests above, I open long. But basically, of course, it's not smart. We have to buy in here, not here. But anyway, here, 10%. When we test and hold the line, I buy in again. Here, 19. Then we drop it lower. I buy in again. 10. this is the simplest way how you can use the line. So now, like you can see, the price wanna test the 50 moving average. Of course, you can go to settings and adjust it, because you understand almost all traders in the world now use absolutely identical moving averages. That's why you can adjust it like, I don't know, maybe 52. A little bit lower, right? So maybe you get a bad entries, or you can use like 56, just like a consensus. So the people start using that 20, 50, 100, and 200. Also, you can adjust and add, for example, SMA, the smoothing line. Turn on, choose the color, for example, go into inputs and choose the SMA, like, let's say 100 days. Then you can try build a strategy, find some on the back test, find personal entries and exits with a back test, and build some condition. I open long when the 50 EMA crossing the 100 SMA. So that's it. I'm buying here. Of course, I already explained to you, this is not all the time will be the best line. So it's absolutely the same story like with the golden cross and the desk cross. So the best entry could be here, right? But here we across below. But of course, someone can build a strategy just with this condition. On 5 minute time frame, you have to understand if you want to build a strategy with some crossing the lines, you will see the more fails and more signals, because these lines will cross each other more often than on, for example, 12-hour time frame. That's why everything absolutely individual and depends on your trading style. For example, we can track the average price of SOL during the last 365 days. So we go into inputs and at 365 days by close. So the average price of SOL now is 127. If we use by low, it will be a little bit different, like this one, 122. If we use by open, it will be a little bit higher, 27. If we use like high, it will be 131. But I recommend you always use by close. And of course, in TradingView, there's a lot of indicators from community. So for example, you can not add many different EMAs. You can use, for example, this one, EMA 20, 50, 100, and 200. But the problem is there is no adjusted settings. So you can choose only the color. On the weekly time frame, it means this is 50 weeks. This is 100 weeks, so 100 candles, multiply close price and divided 100. Now for SOL, it's 104. 200 weekly EMA, average price is 76. It doesn't mean this is like a fair price or 100% we will drop now. Guys, nobody knows. Anyway, sooner or later we will test these lines, but it's just a matter of time. This is just a basic information, what you need to know about EMA and how to work with that tool. In next videos, I will show you some tips and simple strategies what you can use like a beginner with EMA and other tools combined. In trading, divergency refers to the differences in dynamics between a price chart and some price indicator. Why do I tell you some indicators? Because on different indicators, we can identify the different divergences. Just at the beginning, you have to understand divergences, it's not a magic pill. So if you identify and define the divergency, it doesn't mean this is a 100% win rate trade. No, it doesn't work like this one, because if everything could be so easy, everybody could be the millionaires. That's why divergencies, the indicators, you have to combine in the complex with the context, what's going on in the chart. You have to combine it with your risk management and time frames, sentiment on the market at this current moment, and your trading style. Because, for example, if you're a swing trader, you will trade on a weekly time frame or a daily time frame, and definitely this divergency will be stronger than the divergency on 4-hour time frame or on 50-minute time frame. But if you're an intraday trader, you can open position based on your style at 5-minute time frame if you find out the divergency. But with the proper risk management, you have to open position. So like usual, the bigger time frame, the stronger and the more important divergency will be on the chart. Today I would like to show you how to identify, how to find the divergencies using the RSI indicator, relative strength index. It's basically most popular, I guess, indicator. So you just type RSI and choose this indicator. And also at the end of this video, I will show you the monthly huge divergency on the historical BLX Bitcoin chart. When you open indicator, you need to decide what time frame you analyze for divergences, because if you find the divergence on 1 hour time frame, but there is no divergence on 12 hour time frame, you will see more false signals. 1 hour time frame, Solana USDT trading pair on OKEX, RSI indicator. The magnet, here's a drop. You can find out the drop was October 1st, this one, and the price was like $142 per SOL. Then we formed the new lower low on the price. Here's a price going down, down, down. But on the chart, like you can see, we got a higher lows. So here's how the bullish divergency looks like, because we got a lower low on the price, and same time we got a higher lows on some price indicator. This is an example of bullish divergency. And like you can see, it was a great signal for potentially open trade or buying on the spot, you know. But of course, guys, you can't trade just based it on divergency, because divergency didn't show you the points where to fix profit, where to add your stop loss, to identify the take profit levels, to identify the level where you need to add your stop loss. You have to work in a complex. But anyway, the divergencies, it's really powerful instrument. Let's go to 30-minute time frame, for example, and try to find the bearish divergency. So here is, we got a divergency like this lows. So here, lower highs, got it. And the same time from this top, we got a higher highs. So this is a divergency on 30-minute time frame on Sol USDT trading pair exactly at this time period. But you have to understand, on 1 hour time frame or on 12 time frame, it just can be the normal uptrend move without any divergency. So it doesn't mean if you find out some divergency, the price have to dump or pump. But in the moment, of course, it will affect the price. You can find millions divergencies all the time on a chart on different assets. Take a look, example, on historical chart of BTC. This is BLX since June 10. And guys, we formed the biggest divergency ever we ever seen. I use ADZ, my custom indicator set, what I use personally to identify the divergencies, to work with the accumulation distribution zones. So take a look, the highest point was here in April 13. The price was $268. Then we formed the lower high on ADZ, but higher high on the chart. It was like 19K 764. Then we formed another high on the chart like 61K, and here's was another new all-time high like 73K 700. But we formed the biggest bearish, guys, it's a bearish divergency. It's basically the bearish signal. So most likely the history of BTC will be formed something like this one by end of next, I don't know, maybe 10 years. And on the chart, it can looks like this one, for example, and even higher to the 300K, just in theory. And also the big mistake, when the people think, for example, if we see so crazy bearish divergency, we have to drop like this one. It's basically the big mistake, because this is a monthly time frame bearish divergency. But if we zoom out and take a look on a yearly time frame, it just can be normal, healthy, just the beginning of the biggest trend, right? The same story like you find out the divergency on 1 hour time frame and open crazy short, but on 12 time frame we just at the beginning of the uptrend move. In my Telegram channel and Instagram, I will post this picture so you can always come back and double check how to identify the regular divergencies and the hidden divergency. This is a price, this is an indicator. This is a price, this is an indicator. And the same story, you can find out the hidden divergency, but in general, I mostly never pay attention for the hidden divergencies. Open just a classic RSI indicator, open any coin on TradingView and just the back test, try different time frames so you'll understand how easy and how fast you can identify the divergency on the chart. First of all, guys, you have to understand we can trade the zones on different time frames. I would like to show you just example with our initiation accumulation pump model, what I use it for coins after listing on SUI USDT example on a daily time frame. You can use this strategy, how to trade the support and resistance zones on different time frames, depends of your trading style. You can trade it on a 5-minute time frame, on 12-hour time frame, 1-hour time frame, 4-hour time frame. It's absolutely up to you if it's a comfortable personal for you. The small time frame can give you the more trades, because on the small time frame you will see the more fake outs and more breaking outs, right? It can give you the more trades, but not all the time it will be the bigger reward. But if you work with proper risk management and identify the levels and entries correct, it can give you, yes, it's the bigger profit also. So it's always individual. The zone, it's a zone, not some price level. A lot of people made a big mistake. They trying to catch or open trade exactly till penny at some specific price target. But we work with a zone. So it can be the wider zone, it can be the smaller zone, everything individual, absolutely individual. And that's why on a daily time frame, this zone can be bigger one, because we build that zone. On a 5-minute time frame, it can be a smaller zone and smaller stop loss, but smaller gains, because we come back to liquidate your zone more often, right, than on a daily time frame. Another big mistake of traders, I don't know why do they think so, the more often we test some K level or some zone, this zone become stronger. It become weaker. Example on this support level. So after listing, the SUI dump to our zone of accumulation. It's the first zone of interest. Here, drop, we get a buyers here. So yes, buyers buy back this drop, bounce. Another candle, we hold the line, drop, hold the line. So we get a buyers. Drop again, 3 days in a row, we test some level. Yes, we confirm that level are strong. We bounce it, but on the next test, on the second one, it become weaker because there's not enough buyers again. So we test it, and like you can see, we rejected that level, now like a resistance, not like support. And based on this model, when we dump it, we can retest this zone and open short. The short, we open it here on retest, the stop loss over the zone, and now it's of course up to you where exactly add your stop loss. It can be stop loss like this one. It can be stop loss like over this main resistance level. You can reduce your losses if you made a stop loss a smaller one. But of course, the smaller stop loss, the more chances your stop loss can be reached, right? You can open trade on retest. So here's a test, reject it. We dump it, come back, confirm. So we can't breaking out higher. And we open trade. Or you can open trade immediately when we come back. So here is a test. We come back and test. So you can open trade here. Up to your own risk, depends on your leverage. And take a look. We dump it to the next zone of interest. So the next zone of interest, basically, this model can be the zone of take profit. Because a lot of people also made a mistake. They're so greedy and they don't know where to stop. Sometimes take profit level is so important because the people who don't know, and they so greedy, they don't know where to fix the profit. There's not enough. They open trade here. Wait, no, it's not enough. Come back, bam, liquidation. Not liquidation, but stop loss. So you just waste the time. That's why, guys, mark your entry, mark your stop loss, depends on your time frame, and mark your take profit level. Take a look how it's playing out for long. Here, we test it, bounce it, and we come back once again to the same zone, but now it's like support, and all this zone now playing out like support. So here we're playing out like resistance, now it's like support. So we open trade on retest of that zone, stop loss under this zone or under the last week, and we write to the next target. Based on initiation accumulation pump model, we usually fix a profit in 27 zone. So it was like a good trade. So 1 to 13 ratio. 10% stop loss or even like 20% stop loss. Here was a zone where to fix a profit or new all-time high. And here's the last example on SUI. So 27 zone playing out is smaller one, playing out like a resistance previously. So this one, and like support. And we understand, so this all-time high will be like a magnet for liquidity, right? And we can open trade. So here we traded, breaking out that zone. We open trade, stop loss under this level, and the target will be new all-time high. 7% stop loss, 24% profit. The same story can be on 30 minutes time frame, for example. Here we identified the range. This is a fake out, drop, fake out, drop. On the next breaking out, we should open trade. This one, stop loss under a last support line, 3% stop loss, and 23% profit. If we would like to open trade in short, a price action should be like this one. So this is a resistance, drop, support, resistance, support, resistance, support, retest, open trade short, stop loss over this high, and drop 23%. The main problem is identify correctly the zone. And of course, on the 5-minute time frame, you can maybe catch the better entry, because here, for example, it can be like smaller. So zone basically is just a range. Trade, breaking out. Here is retest. You open trade. Stop loss 2%, down 3%, and 6%. Targets for take profit, it will be the liquidity pools. So this one is like liquidity pool where you would like to fix profit. This one, take profit, and you can see the reaction. So here, drop, bounce, drop, bounce. This one, next one, liquidity pool. If you would like to try this type of strategy, I recommend you, of course, use the reply bar on TradingView, backtest some assets, different assets on different time frames. Try to identify that correctly, some zones, and work with that zones. Depends of your risk management, and work on your comfortable time frame. Today, in simple video, I just simplify all information, and I will explain you everything what you need to know, just the basic information about the risk management. It will help you a lot for sure. So trust me, just watch this video till the end and share this video with your friends, so it will be useful. Guys, on YouTube, just a millions videos about the risk management, money management. There's no growl, no magic pill, what strategy to use to be profitable. The key moment, it's discipline and the strategy. So let's move on step by step. So what is risk management? First of all, it's your system. What inside a system? So basically, it's 3 key moments. Trading strategy, your personal trading strategy. If you traded smart money concept, it's good for you. And if you're profitable, it's good for you. If you traded just the classic triangles and you're profitable on a distance, it's good for you. If you traded Elliott waves and you're profitable, it's good for you. So there is no magic or some wrong or right strategies. Got it. So it's a one moment. Second one, it's your psychology, your emotion. You need to work with your emotional state. You need to know when to stop, when to trade, when to not trade. It's totally individual, but it's psychology. Next one, it's money management. So you need to not just count what the risk per trade to open position or a close position. And we talk not only about the futures, we talk about a spot also. And even about investing. And you need to understand your capital, your deposit, and you need to separate your money for living, for your family, to pay the bills, And because in crypto, a lot of people just go all in because some influencers show you this information. Now it's the time to go all in. Just sell your house, just forget about the kids. Go all in now because this talking will skyrocket to the moon. Guys, don't listen to this fancy stories, because on a distance, one day, maybe one time by luck, you get a profit. Second time by luck, you get a profit. But third time, you can lose everything. A lot of stories, unsuccessful stories, so bad stories, horrible stories, the people ruin their life because they gamble too much, they addicted too much because they think if I win one time, I can do this second time. And on the distance, you can lose everything. That's why you have to separate the money for a living, for I don't know, for bills, for your kids, for family. And the second one is split your deposit for 3 parts. It's just my recommendation. Like investing. So this is money what I can afford to invest, and I don't care about this money on a distance for in the next 3 years, 5 years. I don't care. My life didn't change if I invested this money now in crypto, high risky market, and even after 5 years, I will feel comfortable. Second part of this money, it's like for futures trades, intraday trades, maybe swing trades. And the third part, it's just stable coins, just some stable coins for some black swan or some unpredictable moves on the market. You always have to keep some stable coins. Of course, it's so hard because it's like this amount of stable coins treat you. Invest me now because you can get a profit, guys. No, always get a stable coins. And not use that stable coins to add the margin if you're in losses. No, we will talk about a stop loss later. So this is a 3K moment, trading strategy, psychology, money management. It's your system. And you can build it totally individual on your Notion, for example. Just create some list, your rules, your personal rules. For example, you can add moment like, I'm not trade after 9 p.m. So if you feel uncomfortable, if you feel without energy, you work 9 to 5, you after the work, you have to spend the time with your kids. Don't gamble because you can just in frustration click the buttons randomly and lose the money because lack of attention, lack of focus. Next one, it's a risk per daily trade, the weekly risk and a monthly risk. Sometimes we can get a win streak. Sometimes we can get a lose streak, and it's more than okay. It's just a part of our job. It's just okay. So you have to understand it, but you can't control the market, but you can control your risk. This is what under your control. For example, on the daily trades, I just share my my rules. I'm trying to follow my rules. Not all the time. I so disciplined, right? Yes, to be honest. My daily risk per trades can be like 1% or 2%. And for example, that 1 or 2%, let's say 1%, I can divide to 0.5. So I can open 2 trades with 0.5% risk. And if I got one stop loss and the second one, so I lose today the 1% of that amount of money, what I put it for this today intraday trades, I'm not trade today anymore because it can be like a revenge. I want to try to fight with the market, and I will. I'm 100% sure I will do a lot of mistakes if I will start trade more. So sometimes the more is less. That's why it's only up to you, which is comfortable risk per trade. It's comfortable for you, so it can be even 5%, and of course it depends of leverage. Next one is risk per week, because for example, you can get like 3 days profitable. After that, 2 days in losses, and I don't know, 2 days more just neutral at the break even. So it's okay. You're still in the profit, for example. Next one is a monthly risk. So you can afford to lose this month 5% from total capital, what you divide your initial deposit for trades, for investment, for futures trades, and stablecoins we did not touch. So this is a risk. This is a part of risk management. Pretty simple. You can even, probably I will share this screenshot, just simple table in the Telegram channel so you can download it. Next one. We need to talk about risk rewards, asymmetric loss, and optimal risk. Optimal risk have to be the comfortable leverage. About our leverages, I already posted the video, and the size of your leverage absolutely doesn't matter, because the matter is only the amount of money what you put in. Because, for example, if you trade with $100 and it's a 5x leverage, looks like, wow, it's okay. It's okay. Not a big risk, right? It's like you trade it with 500 and you put your stop loss, depends on your risk, but it's absolutely the same way like you traded the $50 but with 10x. So it's absolutely the same. So the stop loss will be absolutely equal. So you have to understand it, because a lot of people think if I use high leverage, I will get a bigger losses. No, the initial money what you put in the margin matter, right? Not the leverages. Also, for example, on some exchanges like Max, I'm not shielding the Max, but sometimes they launch some week or the months or I don't know, maybe the quarter. They give you some trading period without the fee, so you not pay the fee for the trades. So now, for example, I time to time trade a BTC because zero fee. So I can use even the 20x leverage or even 50x leverage, and pay no fee. It's good. It's good. So I save a lot of money. So also pay attention for the fee. Second one, you have to understand your optimal risk per trade. So if I'm trade, for example, 10x, so and 0.5 level in 0.5% per trade, it's like 5% of my initial deposit. That's capital what I put in this trade. But if with the 10x, it will be the 2%, it will be the 20%. So you understand the differences. But it's the same way like 1%, but with a 20x leverage. So you understand. Risk reward, of course, guys, in the books, always, and on YouTube, full YouTube, all of these rules, it's like every trader should trade like risk rewards 1-to-3 ratio. How to count the ratio? I already showed you the example on TradingView. So we just opened a long short position tool and just take a look at the ratio. So you can mark your entry and take a look where's your 1-to-3 ratio will be. This is your take profit. But of course, guys, it's just in the perfect world work like this one. So we open here, and here we should close our trade. Sometimes we cannot hit that level. And what's the point? Better fix some profit, better fix a 1-to-2 ratio, but out in a profit than just wait only 1-to-3 and get a stop loss or the break even after. This is also asymmetry losses. I already posted the separated video about this. This is what people don't understand, and especially for the spot. So highly recommend you save this table and understand the losses, because if the token dump, for example, 80% from the top to recover back to your break even, just to the break even, we need to pump not 80% back. We need to pump 400%. That's the point, guys. So that's what people skip when they talk about the buy the deep. It's good time to buy, right? So all the time use the DCA, all these fancy stories like influencers shield you. So you have to always buy, no matter what, buy. It doesn't work like this one, guys. You can lose a lot of money. So just add your stop loss even on the spot, because if you lose 30%, the token should recover back 43%, back to recover your losses, just the losses, not a profit. The last table, what I would like to share with you in this video, it's about the risk ratio, win rate, and the profit and the distance. What does it mean? The left column here, if you trade 1-to-1 ratio, let's say you open position or buy on the spot, but on a spot you can get a liquidation. Let's say on futures, you open position and you trade 1-to-1 ratio. Your risk $100. It's let's say $100. You open position 10x leverage, so 10% down, you get a liquidation. So your risk $100, and you chase that $100 profit, no matter what happened after that. So it's your plan. You trade 1-to-1 ratio. Next one, for example, 1-to-1.5 ratio, 1-and-2, 1-and-2.5, 1-and-3, 1-2-3, 1-and-4. So let's say in average, if you trade with the risk ratio 1-to-2, your risk $100 and you chase to get a profit $200. Got it? If you open, let's count an average, 10 trades and 4 of them you close in the profit. So your win rate is 40%, 6 in losses, 4 in profit. And if you trade with a 40% win rate and you trade by this condition, like 1-to-1 ratio, on the distance, you will be in the profit plus 20% profit. So this is the way how you can count. But for example, if you will trade and your win rate only 30% and you trade 1-to-2 ratio, you will be in losses 10%. If your strategy is 50% all the time, it's like a balance, 50% profitable, and you trade like 1-to-3 ratio, so you like open 5 trades to 1-to-3 ratio in the profit, and 5 you get a liquidation, for example, or the stop loss, you will be 100% profit on a distance. Nice one. Not a big numbers, maybe, because people chase like 5,000% gains or so, with the high leverages. But guys, on a distance, it's good one. It's good one. So if every single month you will trade with a 50% win rate with 1-to-3 ratio, every single month 100% profit. So imagine it will be like 1,200% gains to your initial deposit during the year, 12 months. So that's the point, guys. So I will leave all of this table, on Telegram channel, so you can just save it. I highly recommend you guys share this video with your friends, subscribe channel, hit the like button, hit the bell notification button. Don't forget to join my Telegram channel. See you next time, guys.